Nilesh, sir, would you like to kick off the session? Nilesh, sir? So I think we'll start off. Uh,
Sure.
Welcome all the participants who are third day and of the MLI workshop. Without taking too much time, I'll quickly introduce Anish sir, who is our speaker for the first session for today. I'm sure most of you know Anish sir, but for those who don't, Anish sir is a partner with SRBC and Associates, which is a member of EY Global, and he has over 35 years of experience in tax advisory, compliance and litigation assignments, and specializes in income tax litigation and advisory. In the past, he's worked with BSR and Co. and also his own firm AM Thakkar and Co. He's a core member of the CTC and BCAS, and was also the president of the CTC in 2021. And he's also the editor of the CTC's journal, and is a member of the editorial board of the ICAI's the Chartered Accountant Monthly Journal. Uh, he's written articles on various topics in newspapers, magazines, and professional journals, and also edited books on Section 194R and the Guide to Income Tax Practice, and on royalties and FTS. And he regularly speaks on various seminars and conferences for various forums such as the ICAI, the BCA, CTC, our very own IFA, and for other industry forums like the BCCI, IMC, FICCI, CI, etc. And he was also visiting faculty at Sydenham Institute of Management Studies and Research. So with that, Anish sir, I'll hand over the session to you.
Thank
Thank
you
you.
very much, Kush, and a warm welcome to all of us here at this session. Uh, this is an MLI course, and ultimately, yes, MLI is something which is relatively new. Of course, in the past, I think IFA as well as I think many other organizations have dealt with this, uh, complex. I wouldn't call it piece of legislation, but complex agreement, or instrument, if I may use that word term correctly. This complex instrument has been dealt with. But again, we are here today to explore more facets of the MLI. And today we are going to explore part 4 of the MLI, which basically deals with articles 12 to 15 of the MLI, which deal with permanent establishment and measures taken under the BEPS initiative to figure out how an artificial avoidance of PE can be mitigated or reduced. So with that, let me start off by just sharing my screen. And of course, as all of you know, I have a little bit of a vision challenge. So whenever I speak online, at least I go off video. So I'm going to go off video, and we will then look at the slides, and I think that's probably easier. So really, what we're looking at today is the changes to the PE definition through the MLI. And before we go to any academic discussion, let us first invoke the blessings of our gurus. Dhyan Moolam Gurur Murti, Puja Moolam Gurur Padam, Mantra Moolam Gurur Vakyam, Moksha Moolam Gurur Kripa, Om Shri Guruve Namah. With that, let us start. We are all aware that the G20 and the OECD in 2013 brought out an entire series of about 15 action plans for reducing or eliminating base erosion and shifting profits from high tax paying jurisdictions to low tax paying jurisdictions. And they came together, and they came up with their recommendation in 15 action plans to tackle this tax avoidance, improve the coherence of international tax rules, and ensure a more tax transparent environment. And in 2015, the final report of Action Plan 7, which forms the base of Article 4 of the MLI, was released. MLI, of course, was released in 2016, and 24th November 2016 was the date on which MLI was published. The signing ceremony happened on 7th June 2017, and it entered into force from 1st July 2018. And India was amongst the first 68 countries to approve and ratify the MLI. And as far as India is concerned, the first day of application of the MLI is really 2020. And therefore, what part 4 of the MLI actually considers is modification of the definition of an agency PE. Then there's a recommended principal purpose test to deal with strategies involving the splitting up of contracts between related enterprises, and also definition of independent agent has been tightened. So really from that perspective, what is preparatory auxiliary activity? So Article 12 deals with commissioner type of arrangements, which are not really popular in India. But there are similar strategies, and we'll see how domestic law has also been amended to, harmonize itself with the MLI provisions. And then, conclusion of contracts is one part, splitting and carrying on of complementary functions or coherent functions is the other part, and splitting up is the third part. And of course, Article 15, which is the last article, which deals with what is closely related enterprises. So really, MLI, as we all know, is not like a protocol. It is like a instrument which sits over and above the treaty. And therefore, really, you don't need a bilateral amendment to implement the MLI. There are various actions that you need to take for various parts of the MLI, which I'm sure that you already have read in the earlier sessions. So therefore, we will not get into that. Again, what is entry into force, entry into effect, I'm not going to go into. Suffice it to say that as far as India is concerned, the earliest date that an MLI applies as far as certain treaties are concerned, about 25 odd treaties, was 1st April 2020. And now, of course, many more treaties have been added, and we have close to about 100 treaties which now are, in the scope of the MLI. So really, first let us deal with what explanation 2 to section 911 and articles 12 of the MLI and the BEPS action report say, as far as the definition of business connection is concerned and the agency PE is concerned. So as we go back into history, you will remember that business connection actually was first introduced in section 42 of the Act 2022, 1922. And the most celebrated and the most talked about decision on business connection, because the term is not defined, is R.D. Agarwal. And R.D. Agarwal, though not defining business connection, actually gave some color to what the term is understood as. And the I quote from the judgment, the expression business connection undoubtedly means something more than business. It predicates an element of continuity between the business of the non-resident and the activity of the taxable territories. A stray or isolated transaction is normally not to be regarded as a business connection. Business connection may take several forms. It may include carrying on a part of the main business or activity incidental to the main business of the non-resident through an agent, or it may merely be a relation between the business of the non-resident and the activity in the taxable territories, which facilitates or assists in the carrying on of that business. A relation to be a business connection must be real and intimate, and through or from which income must accrue or arise directly or indirectly to the non-resident. So really, the term or the scope of the term business connection is very, very wide. And as way back as the 1960s, this definition or this meaning was given to the term business connection. However, in 2003, the explanation 2 was added, where the activities of an agent specifically were included in the scope of the term business connection. And these activities were the activities of an agent other than an agent of an independent status, an agent who either had habitually exercised the authority to conclude contracts in the source state on behalf of the non-resident. So that was what was added in 2003. This was amended in 2018 to align itself with Article 12 of the MLI. And let us see what exactly was amended and how does this harmonize itself with the MLI. If there are differences, what are those differences? So really, as far as the 2018 amendment is concerned, the 2003 amendment said that if an agent has and habitually exercises an authority to conclude contracts on behalf of the non-resident in India, then there is a business connection. To this, what was added was that he habitually concludes contracts or habitually plays the principal role leading to the conclusion of contracts by the non-residents. And the contracts could be either in the name of the non-residents, or for the transfer or ownership of, or for the granting of the right to use property owned by that non-resident, or the property that the non-resident has the right to use, or for the provision of services by the non-resident. So really, it was not important that the conclusion of the contracts had to be, or the non-resident had to be a party to those contracts. If the contracts were for transfer of the property of the non-resident, or granting of the right to use the property owned by the non-resident, or for the provision of the service by that non-resident, irrespective of whosoever the contracting party was, there would be a business connection in India if there is a agent who plays the principal role, habitually plays the principal role leading to the conclusion of contract for the non-residents. And the important thing is the role has to be habitually played. So it has to be played regularly, more than once for sure. In fact, not only more than once, but with systematic regularity, and the role has to be a principal role. What is meant by principal is a role that ultimately leads to the conclusion of contract, with substantial conclusion of that contract, which means that there is only really very little to be done from the non-resident sitting outside of India. And we will see how Article 12 actually amplifies that. But today, the definition of business connection does not really go beyond playing a principal role. And it leaves, therefore, us a little ambiguous in terms of what exactly a principal role means. But again, principal is understood as the primary, the dominant, the main role. And therefore, if a non agent of a non-resident in India plays that kind of a role, leading to the conclusion of a contract, right? Which are of those three types, then the agent is deemed to have a business connection in India. Of course, this is in a non-treaty scenario. This is a scenario under domestic law, and really in that sense. So other than that, the definition really remains the same, which means, which includes has no authority but habitually maintains the stock of goods, habitually secure orders, does not include any business activity carried on through a general broker, commission agents, etc., etc., etc. And really, there's a second proviso which is important, which basically says that a person who works mainly or wholly on behalf of a non-resident, or on behalf of such non-resident and other non-residents which are controlled by the principal non-resident, or have a controlling interest in the principal non-resident, or are subject to the same common control as the principal non-resident, are deemed to not be an independent agent. So this again is something that also finds part in the MLI Article 12. It is further amplified by two tests. One is control and the other is shareholding, which we will see. Here, this only talks about control. So from a perspective of domestic law, again, if we see what the explanatory memorandum of the Finance Act 2018 said, and this is applicable from 1/4/2019, which is assessment year 1920. MLI is applicable from 1/4/2020, which is assessment year 2021. So this came into effect 1 year before the MLI did. Rationale that was explained in the explanatory memorandum to the Finance Act 2018, which said that prior to the amendment, the scope of business connection under the Income Tax Act was similar to the provisions relating to the dependent agent PE in the DTAAs. You had the same language. There's a person other than an agent of independent status who has and habitually exercises the authority to conclude contracts or concludes contracts, so on and so forth. In many cases, with a view to establishing a PE under Article 5 of paragraph 5 of Article 5 of DTAA, the person acting on behalf of the non-resident negotiate the contract but does not conclude the contract. And if we read Action Plan 7, the language somewhere seems to be similar to say that everything happens in the source state other than the actual signing and the actual conclusion of the contract. If that is the situation, merely on account of this signing happening overseas, there is, in a way, base erosion and profit shifting, and therefore the G20 and the OECD also concluded that something like this needs to be curbed, which is why the domestic law also was amended. The GECD, which is G20 and OECD, under Action Plan 7, reviewed the definition of PE with a view to preventing avoidance of payment of tax by circumventing the existing PE definition by way of commissioner arrangements or fragmentation of business activities. We look at both of these. Commissioner arrangement is an arrangement where somebody actually acts on behalf of the principal but bills in his own name, right? He has no ownership to the goods, but he still bills for the goods in his own name. So there are situations where, unless you are the legal owner of property, you won't be subject to tax in a particular country. And because you're not an agent, you do not act on behalf of somebody, you do not create a permanent establishment. So therefore, these are commissioner arrangements. These are more creatures of civil law. India is a common law country, and therefore commissioner arrangements are not very popular in India. We will not go into this for the purposes of this discussion. Recommendation under BEPS action plan have now been included in the Article 12 of Multilateral Convention to implement tax treaty related measures to which India is also a signatory. And provisions of domestic law being narrower in scope are more beneficial, and therefore the provisions have been widened. So in order to align domestic law with Article 12, domestic law was amended by amending explanation 2 to section 911. Now, let us understand what the implications of this amendment are, really. So, if, for example, India does not have a tax treaty with a country in which a foreign company limited is a tax or foreign agent limited has a tax resident, then that foreign company has a business connection in India. Income earned by that foreign company would be subject to tax in India in terms of Section 911 as a result of business connection by virtue of this amendment, if the facts are what we narrated. If India has signed a tax treaty with the country in which F Limited is a tax resident, however, that country has not notified its tax treaty with India for the purposes of MLI. It is not a covered tax agreement, as you would have learnt in your earlier session. Then F Limited has a business connection in India, but the older version of the treaty pre-MLI will continue to apply, and the Indian agent will not constitute an agency PE. So therefore, even though domestic law taxes you and takes you under its net, you have a relief in terms of the treaty because the treaty has not been notified as a covered tax agreement. India has signed a tax treaty with the country in which the foreign company is a tax resident. The country has also notified. Then there is a business connection in India in terms of explanation 2 to 911. In terms of treaty, F Limited would not have a PE if the contracts are not routinely signed. And we'll come to the language of Article 12 and the treaty language of the MLI, where it requires, in addition to the Indian agent providing or playing a significant role in the conclusion of the contract, in addition to that, there has to be a routine or a habitual conclusion of contracts by the non-resident. So typically, you would have to establish not only the fact that the Indian agent plays a very significant or the principal or the main role in the conclusion of the contract, but also the fact that the foreign principal routinely accepts what the Indian agent has done and signs the agreement in a routine manner, concludes the agreement in a routine manner. If that is not done, you may still not have a permanent establishment under Article 12 of the MLI and read with Article 5, para 5 of the treaty. And of course, if that is not the case, then you will obviously have taxing rights available to India. So let's look at what Article 12 really says. Agency P really will be deemed to be established if a person acting in a contracting state on behalf of the enterprise of the other, and in doing so, so first condition, and which is very important, is that there has to be an agency relationship between the person in the source state and the person in the resident state. If the agency relationship is not there, then all of this is useless. But presuming there is an agency relationship, in playing the role of the agent, the person in the source state habitually concludes contracts or habitually plays the principal role leading to the conclusion of contracts. So far, so good. This is the same language as is contained in explanation 2 to section 911. But please see this, that are routinely concluded without material modification by the enterprise. This language is missing in section 911 explanation 2. As far as treaty is concerned, therefore, in order to again allege that there is a PE, the department has to prove two things. One is that there is a habitual conclusion of contracts or the habitual playing of principal role in conclusion of the contracts. But the second thing that has to be proved, and equally contrary, that you have to prove to the contrary, is that the contracts are not routinely concluded without material modification by the enterprise. So if the non-resident actually sits and looks at the contract, he applies his mind to the contract, he does not, as a matter of normal course, accept what the agent has sent him by way of a draft of a contract saying, this is what I have, tentatively agreed with the Indian party. Now, please ratify this. And if the person sitting outside India, his principal, actually sits and looks at the contract, he does not, as a matter of routine, conclude the contract without any material modification. He asks 10 different questions. He modifies some different clauses, in which case then there should be no PE. This part is missing in explanation 2. But as far as PE is concerned, Article 12 will require that. So this is something which is very important. Again, the three different scenarios that we saw in explanation 2 were that the contracts are either in the name of the enterprise or for the transfer of ownership of or the granting of the right to use property owned by that enterprise or the enterprise has the right to use, and for the or for the purpose or for the provision of services by that enterprise. So these three things remain the same. The contract may not be exactly in the name of the non-resident, but it has to be either in his name, or if it is not in his name, then it's for transfer of property that the non-resident owns, or the right to use of that property, or then the provision of services by that non-resident. Now, if that happens and these two conditions are satisfied, so three conditions really in a way: agent, habitual conclusion of contract or playing the principal role, and the routine conclusion of contracts by the non-resident without material modification. Only and only if these three conditions are satisfied will there be an agency PE constituted as far as the non-resident is concerned. So please remember this. Sometimes I have had debates with tax officers who say that no, no, you know, your entity is really doing everything here in India. But question is it doing it as part of its own function, or is it doing it on my behalf? That is the first thing that I have to see. Second thing I have to see is that does it do this by way of a habit and normal? So do I have repeated transactions of this kind? And number three, does my foreign principal just rubber stamp those contracts, or does he then apply his mind? Does he suggest material changes? Does he say, this clause is not proper? He asks you to push back on that clause. If all those conditions do exist, then it would be very difficult to allege a agency P being constituted. Now, this MLI provision, of course, does not apply if a person who acts on behalf of a foreign entity carries on business as an independent agent in the ordinary course of his business. So one has to remember that this conditions of habitual conclusion or playing a principal part in the conclusion of the contracts, etc., are applicable only to an agent which is not a independent agent, right? In other words, an agent which is a dependent agent. Now, if I am an independent agent, how do I prove I am an independent agent? I have to be not only legally independent, so I may be the subsidiary of that person and I would still have my own independent board of directors, independent decision making, etc., but I should also be economically independent, which means that I cannot have only that enterprise, and therefore one more, anti-abuse provision added to say that if I work only for that enterprise and or closely related enterprises, then obviously I will not be regarded to be an independent agent. So therefore, if say I am somebody who services not only that particular entity, but other entities in the group, then I will become a dependent agent merely because I am not serving anybody else. But the relationship of agent and principal has to be proved, because people then sometimes argue, departmental officers particularly, to say that your BPO services not only you, but it services other group companies as well. But first condition is it has to be an agent. Second condition is it has to play a principal role in conclusion of the contract. Third condition is that that particular non-resident has to routinely accept what this agent is doing. Yes, if that agent acts on behalf of not only his principal but also closely related enterprises, which could be group companies, and there's a definition which we'll come to on the next slide, that agent is not to be regarded as an independent agent. So therefore, decision tree is like this. Am I an independent agent? Firstly, am I an agent? If I am not, no P, matter closed. Second decision point is, am I an independent agent? For looking at whether I am an independent agent, what is to be seen? Number one, am I economically dependent? And two, do I service not only that particular enterprise, but also closely related enterprises? If either of those two things do not exist, then I am not an independent agent. And therefore, then again, PE is not to be looked at. If I satisfy the test of not being independent, then of course I have to look at the third test, which is what is my activity? What does the principal do with what I give him as output? Does he accept it routinely? Does he conclude contracts on that basis? Or does he then apply his own mind, which will decide the PE? So again, there is a layer of complexity added to what it was earlier, but it's not that there is doomsday here. It's not that the department can allege PE as far as any type of activity is concerned. And therefore, it's very clear that, this has to be looked at in that fashion. Now, really, in terms of, this definition, right, of closely related enterprises, what Article 15, so this is again the alignment that we just spoke about. I'll come back to that in a bit. But a closely related enterprise is a person which has control of the other, or both are in under the control of the same person or enterprises. And there's also a quantitative shareholding test. If one person possesses directly or indirectly more than 50% of the beneficial interest, aggregate vote, and value of shares in beneficial equity interest of the other, or if a third person possesses directly or indirectly more than 50% of the beneficial interest or aggregate vote and value of shares beneficial equity interest in the company, in that person and the other enterprise. So if I have more than 50% holding in a particular company, then I am a closely related enterprise. If there's a third person who has more than 50% holding in both of us, that person will also be a by virtue of that person holding, 50% in both of us, we will become closely related enterprises. Now, this is again, as you have been reading, direct or indirect. So ultimately, indirect holding is also to be looked at. It is not that it is just the immediate holder or the shareholder that we would look at. So one has to be a little careful in terms of looking at when you would constitute an independent agent. Now, this is again applicable for the purpose of all, 12.2, 13.4, and 14.1 of the MLI. And of course, if, only, and this is an automatic application, Article 15, it you have to opt out and express the reservations, which nobody has done. India has at least certainly not done. Now, looking at explanation 2 and 911, very clearly there are certain extra words that we have seen, right? So preparatory and auxiliary activities is excluded as far as MLI is concerned, and we'll come to that in Article 13 just in a little bit. As far as the business connection definition is concerned, there is no exclusion at all for preparatory and auxiliary, right? In terms of habitually exercising authority to conclude contracts, of course, explanation 2 is wider and the MLI is narrower, as we just saw. And also that importantly, explanation 2 does not require that all the activities of the agent have to be in India, right? MLI has said that all the activities has to be in the source country. So explanation 2 is far wider. Of course, MLI will in that way give you a certain degree of protection. So now coming to Article 13 of the MLI, right? This was the first article which basically changed the definition of what an independent agent is, what a dependent agent is, and brought in certain degree of, how do I put it, a more of a ring fencing in terms of what the activities could be as far as the agents were concerned. Now, there are certain specific activity exemption and anti-fragmentation rules which are contained in Article 13. Let's look at those. Now, as we know that Article 5.4 of the model convention excludes certain activities from the definition of PE. For example, if there is a use of facilities solely for the purposes of storage, display, delivery of goods or merchandise belonging to the enterprise, then that does not constitute a PE under unamended Article 5.4. Also, if there's only a maintenance of stock of goods or merchandise belonging to the enterprise solely for the purposes of storage, display, or delivery, that activity also does not constitute a permanent establishment. The maintenance of a stock of goods belonging to the enterprise solely for the purposes of processing by another enterprise, the maintenance of a fixed place solely for the purposes of purchasing goods and merchandise for collecting information for that merchandise, for that enterprise, and the maintenance of a fixed place of business solely for the purpose of carrying on for that enterprise or any other activity of a preparatory or auxiliary character. So if there is these activities and there is other activities which are preparatory and auxiliary, then there is no question of a PE and under the unamended this thing. As far as our section 91B is concerned, it specifically exempts the income which arises in India from the purchase activity for the purposes of export. And there was always this question on whether these activities by themselves were regarded as preparatory or auxiliary, or whether these activities could basically be regarded to be core activities, and these would only not constitute a PE for the non-resident only and only if the activities were of a preparatory or auxiliary nature. So, you know, the activities that are undertaken in the source country are important, and there was misuse of some of it in terms of the fact that these activities per se, even though these may not be preparatory or auxiliary in character, were somewhere regarded as so because of the wording of the treaty. And then there was a situation where the ambiguity arose. So from that perspective, again, Article 13 of the MLI was introduced, and really what was just said in Action Plan 7 is just, I am going to read this, that some state, however, consider the BEPS concern related to Article 5.4 essentially arise when there is a fragmentation of activities between closely related parties and those other concerns which are appropriately addressed by the inclusion of the anti-fragmentation rules. Right? That was one part. The other part which was said is that the states therefore agreed to modify Article 4 so that each of the exemption included in Article 5.4 is restricted to activities that are otherwise or of a preparatory or auxiliary character because business is changing. And therefore, the working group really thought and said that, these activities per se may not be preparatory or auxiliary. And therefore, we'll give 2 or 3 options to the contracting states. And therefore, they said that, look, what is preparatory? Again, something which is carried on in compile or contemplation of essential and significant part of the activity of the enterprise as a whole. So it is a precursor to an activity which is a precursor to an activity. And auxiliary is carried on to support without being part of the essential and significant part of the activity of the enterprise as a whole. And activities which are mentioned in Article 5.4 could either be preparatory or auxiliary, depending on whether the activity of the fixed place of business forms an essential and significant part of the activity of the enterprise as a whole. So therefore, 2 options really were given to the contracting state. One is that you put in your treaty or you opt for an option that all of these activities will be preparatory and auxiliary only if you specifically call them to be preparatory and auxiliary. Or secondly, you leave these activities as they are. You presume that they are preparatory and auxiliary, but you introduce an anti-fragmentation rule in your this thing to say that if the activities are broken up, right, into more granular activities, and those activities are performed either by different parts of that particular person or then different closely related enterprises, then you would not be allowed to regard these as preparatory or auxiliary activities. So really, in a way, Article 13 does incorporate the changes to the specific activity exemption given by Article 7. And Article 13(1) provides really three alternatives. One, as mentioned, specific activity exemption only and only if the listed activities are preparatory or auxiliary. So somebody has to look at each and every activity threadbare and based on facts and circumstances decide whether these activities are preparatory or auxiliary in character or not. If these activities indeed pass the preparatory or auxiliary test, we saw what is preparatory, what is auxiliary. Preparatory is a precursor. Auxiliary is an activity which is a pure support activity and is, independent of the core activity. If that is what it is, and those, storage, display, purchase, maintenance of fixed place for all of this constitute a preparatory or an auxiliary activity, then there is no P. Or you could take an option where these listed activities which are listed in 5.4, storage, display, warehouse, purchase, processing, all of those activities are completely exempt from PE. So I don't look at PE when I look at this. But you will have an anti-fragmentation rule in your this thing to say that if these activities are conducted by different parts of the enterprises within the same country or by two enterprises in different countries or the same country, then really you will not be able to conclude or contend that these activities are preparatory and auxiliary. Third option in that sense is to not choose any option and provision as per existing agreement will remain in force, but you then, you know, introduce an anti-fragmentation, or you may not even introduce an anti-fragmentation because it is not mandatory, right? Report actually indicated that the anti-fragmentation application, right, saying that this is an opt-in, you have to, it's otherwise presumed it's there. You say that I don't want to, adopt anti-fragmentation, this is fine. So India, in a way, is silent. India said that I want option A, which says that I will get the MLI to amend all my treaties to say that all these activities will constitute a permanent establishment only and only if they are preparatory and auxiliary based on facts. And two, I will remain silent on anti-fragmentation, which means that anti-fragmentation automatically comes into my treaty, where if these activities are broken up and one part of the enterprise or closely connected enterprise carry on these activities and the combination of these activities is not preparatory and auxiliary in nature, then I will not be deemed to have a permanent establishment. So from that perspective, India in a way has been the most conservative as far as all these options is concerned. Now, really, what is the implication, right? Because both countries have to opt in or opt out for certain options. So if both countries, for example, opt for option A, saying that we will consider these activities to be preparatory based on facts and circumstances, and only we consider these to be preparatory will we consider this or not preparatory, then we will consider this to be no PE. But we do not have an anti-fragmentation rule. Then option A replaces the current treaty, which means that in a way, each activity will have to be looked at, and by itself, you will have to decide whether there is a PE or not. There is no scope for combining these two activities. If there's a country X which chooses option B and country Y also chooses option B, and both opt in for anti-fragmentation rules, which will be most of our cases, then option B plus anti-fragmentation rule will, in all our treaty partners, which are OECD countries, right, will have this, where option B will replace the anti-fragmentation rule. And sorry, option B will prevail and anti-fragmentation rule will replace the current provision. So these activities will continue to remain preparatory and auxiliary, but you will have to look at these activities as a combination. And what is that combination resulting in? If that combination results in a preparatory or auxiliary situation, then really you will have to examine the applicability or otherwise of a permanent establishment. If country X looks at option or chooses option B, right? Sorry, chooses option A, and country Y chooses option B along with anti-fragmentation, then because the choice of option is not uniform, anti-fragmentation will only be added. So therefore, your treaty, whatever it is, your treaty could have two situations. One, calling all of this as preparatory and auxiliary, or saying that this will be regarded to be no PE only and only if they are preparatory or auxiliary. Both situations can prevail. But an anti-fragmentation will be added to these provisions to look at the combination. Now, if country X has option B and country Y has option A and there is no anti-fragmentation, there's no change in your treaty provision because anti-fragmentation has not been opted for, and there is a difference of opinion for option, so your treaty remains as is. No option is chosen by any of the country, but anti-fragmentation both opt in, then anti-fragmentation will be added. And if they do not opt in for anti-fragmentation, then there will be no change to the treaty. Again, this sounds a little complicated. It's not as complicated as it sounds, because ultimately what one has to see is that there has to be a uniformity in the option chosen by the two countries and whether the anti-fragmentation is chosen or not. Depending on that, your treaty will be amended. And now we have the benefit of synthesized text. Of course, synthesized text, as you know, is not an authentic text, but it at least gives you guidance in terms of what exactly we are looking at. Now, fragmentation, let's just understand a little bit of background. So, the breakup of activity in that sense into preparatory and auxiliary is a safeguard saying against fragmentation, because to say that if there is something which is purely preparatory and auxiliary in nature, then there should really be no PE. But if there is a operating business in a particular country, you break it up into smaller and smaller operations. That smaller and smaller operations continue to be carried out either by different parts of that particular non-resident, different liaison offices, different branches, or these then get split up or fragmented into different entities of the group. And those entities carry on those activities in the source state. Then really, under the current or the pre-MLI, not the current, pre-MLI situation, we had no way to tax those activities because we would look at each activity as a separate activity and decide whether there is a PE or not. Again, the words that the MLI uses are locally and organizationally separate. So if the activities are, say, locationally separate or they are organizationally separate, so different entities carry on different. Then again, you will have to combine them for the purpose of MLI. If they were separate, otherwise you would not look at these activities in the pre MLI scenario in a combined manner. You would have to look at each activity separately. And therefore, MLI says that if you perform what is called complementary function, then you are not organizationally separate. And we'll come to a few examples on what organizations, what organizationally separate are and complementary functions are. But some of the India's tax treaties already contain a specific provision in Article 5.4, which is comparable to an anti-fragmentation rule. For example, UK, Norway, Australia, Singapore, etc. No Indian DTAA pre-MLI dealt with fragmentation of activity with closely related enterprises or associated enterprise because it was understood that you were looking at transactions only between a particular person and its counterparty. You were never looking at a transaction between that particular person and a related third party, which could, in a way, complement or be inextricably linked in terms of the functions that you would, that your counterparty would perform. So, pre-MLI, this was never looked at as far as closely related enterprises or associated enterprises were concerned. Action 7 actually recommended to extend the analysis to activities carried out by closely related enterprises at the different place or same place. So again, two parts, locational separation and organizational separation, both were recommended by Action Plan 7 to be ignored. And ultimately, you collate both the activities and amend Article 5.4. That was the rationale behind enacting Article 13 of the MLI. Now, what does Article 13.4, which deals with anti-fragmentation, cover? It covers situation where the combined activities of closely related person at the same places or different places in the same country exceed what is considered to be preparatory or auxiliary. It's an option for parties to adopt Article 13.4. It may apply even if option A or B of Article 13.1 are not chosen. So anti-fragmentation is completely different from what you call or not call prep or ox, right? It is an independent provision. Now, what do you need to do? And we'll come to one decision where all of this has also been dealt with. So, we will be able to actually practically examine what has been done. To my mind, that's the only decision I know that has been delivered in the context of MLI. If somebody has another decision, I have no idea. At least I have not come across. But there's one decision that we will deal with. Now, specific activity exemption under Article 2 and 13, Article 13.3 are not available when all of these three conditions are satisfied cumulatively. The same enterprise or a closely related enterprise carries on business activity at the same place or at another place in the source state. So, there has to be, if there is an activity which is carried on by a closely related enterprise in a place other than a source state, that is not to be looked at. What we're looking at is the activities carried on. If India is the source state, then in India. So if I, as the non-resident, have a particular activity being carried on, a closely related enterprise of mine also has some other activity carried on in India only. And at least one of these places where these activities are carried on constitute a PE. Okay. Or overall activity resulting from the combination of these activity carried on by the two enterprises is not of a preparatory or auxiliary character. So one, different parts of me or me and closely related enterprise carry on certain activities at the same place or another place in the source country. Condition one. Condition two, at least one of these places either is a PE, or if I look at the overall activity between, what I do and combine it with what the other closely related enterprise does, or I look at whatever my parts do, if the overall activity resulting from the combination of all of this is not of a preparatory or auxiliary character, and the aggregate business activity constitute complementary functions that are part of a cohesive business operation, then I will not be able to avoid the constitution of a PE. I will not be able to conclude that my activities in the source state are of a preparatory or auxiliary character, and therefore there is no permanent establishment as far as I am concerned, because part A carries on only a small activity. Part B carries on only a small activity. Enterprise A carries on small activity. Enterprise B, which is closely related, carries on another small activity. All of these smaller activities will need to be combined provided they satisfy all of these three conditions. So it's again something which one has to look at very, very carefully. Let me emphasize two or three things. One is both the activities have to be carried out in India. You cannot combine, or, as far as in India is concerned, where I'm ditching source state and resident state for the purpose of this understanding. If somebody carries on a particular activity in India and his closely related enterprise carries on activity somewhere else, those two cannot be combined. Condition number two, at least one of the activity or the places at which one of the activities has been carried out has to constitute a PE. Now, if they are carried on for both enterprises, any one constituting a PE for any one is fine. You don't have to look at, oh, मेरा PE तो है ही नहीं, दूसरा मेरा related enterprise है, उसका PE है, and therefore I don't have to consider this. For me, this is not applicable. That's not what it is. Any one of the places, if it constitutes a PE, then I have to, look at the third condition. Or none of my activities in the two enterprises or in the two parts constitute a PE. But if I combine the two activities, then the overall activity resulting from the combination of these two activities carried on is not of a preparatory or auxiliary character. Then I will have to look at whether these aggregate activities constitute complementary function, which are part of a cohesive business operation. So there are enough safeguards available to, not make an illogical addition of different activities. But again, sometimes, the understanding of all of this becomes a little bit of a challenge. I've seen many people struggle with the understanding. Somebody says, oh, but, there is an activity which is carried on in India and an activity which is carried on outside India. Take a classic case of, a support activity being carried on in India and carried on outside India. Somebody says, no, no, some non-resident carries on its business in a foreign country. There is a BPO which carries on business in India. If I look at the two, they are complementary because one cannot survive without the other. And therefore, they are part of a cohesive business operation. But sometimes people forget that the two activities have to be carried on in the same state. Also, does the activity of a BPO constitute a PE? The answer to that is no. If it does not, then one. But then I have to look at, okay, what is the overall combination of the two? So presuming that the overall combination is a cohesive business operation, which it is, but my activities need to be carried on in the same state. This is what people forget. And therefore, I am laying repeated emphasis on, because that is something that one, when we look at that tribunal decision, we will appreciate that. Now, again, we've looked at the definition of closely related enterprise. It is the same definition. So I'm not going to be, looking at this. Let's look at some 4 or 5 case studies, which will probably explain what this whole Article 13(4) is all about. So say PQR is an online selling company. It sells goods to people in India online. It maintains a large warehouse in India involving a significant number of employees who work for the main purpose of storing and delivering of goods. As we saw, maintenance of a place of business only for storing and delivering should typically, in the pre-MLI scenario, not constitute a PE. Okay. If the treaty between India and the foreign countries based on OECD model convention, example Germany, Belarus, Australia, then the storage function by itself will never constitute a or a non-preparatory activity. It will always go away being a preparatory activity in the good old days. Post MLI, what happens is that the activity at the warehouse may not qualify as primary, preparatory or auxiliary activity, because the warehouse report, it's an important asset, right? And it requires a large number of employees. And it's a, essential part of the sales and distribution function of PQR. If, say, for example, this warehouse were not located in India at all, it were located somewhere else in some other country, then obviously the delivery time and the efficiency of the delivery to the customer would not happen. And therefore, one will have to look at what happens to that warehouse. Is it really part of my cohesive business operation or not? The answer to that is yes, right? And therefore, one may have to look at, okay, if I am doing some activity here in India, which is the sale activity, and I am doing an activity which is the warehousing activity, should I look at the two activities in a combined scenario? And one may have a little bit of a challenge in, saying that the warehousing activity is only a preparatory and auxiliary activity. Okay. But what if these services were availed from an independent third party, right? It's not a closely related enterprise. So if the warehouse belongs to my closely related enterprise, I would still probably be questioned under the MLI. If my warehousing services are availed from a completely third party, I may still not be looked at as being constituting a PE under the MLI scenario also. Now let's look at the second case study. There is our company in the state of residence, which is a foreign company, which is an owner of raw materials and semi-finished goods. It enters into an arrangement with a company in state S, where ultimately there is a toll manufacturing in state S, and final product also gets delivered to state S in that sense. So R will supply raw materials and finished goods to S company, and the final product ultimately will get sold to a third party, okay, and which may be in the state S. Now, what is the question, right? Is there a fixed place of R at its disposal? The answer to that will depend on facts. Typically, the answer would be no, because the warehouse belongs to S. It does not belong to R. But if R has some control, some access to the warehouse, then that may be a different issue. For the purpose of this discussion, let us presume that there is no access unfettered to R as far as the warehouse is concerned. If there is no unfettered access, then I would believe that it is a simple case of no PE, because even though S may be a connected enterprise, right? You may not have a PE because it is still an activity which is different. Now, if S is independent, it does not only warehouses or warehouse ours products, but it warehouses others, then the case even becomes stronger. If R is a distributor of products, which is, sorry, if S is a distributor of products of other enterprises, the activity of mere maintenance of stock of goods belonging to an enterprise did not part of the distributor. So this is a typo. Please correct that R to S. I'm so sorry for the typo. Yeah. If I look at case study 3, then PQR is outside India. It is a seller of spare parts. It sells spare parts to people in India. There is a fixed place in India for the purposes of repairs and delivery. Then what happens? Okay. Say the treaty between, again, India and country A is based on the same OECD model. In the pre-MLI, there was no question of this ever constituting a PE. But in the post-MLI scenario, it may not qualify as preparatory and auxiliary, since repair function is undertaken in addition to delivery. So repair is an important function, right? If it was still a mere delivery, one would have probably, taken a different view. But since repair is added, one may have to look at it in a different scenario. Case study 4. There's a foreign company which is engaged in the manufacture of textiles. That company has a purchase office in India which purchases raw material from India required by the FCO. The employees who work at the purchase office have special knowledge of the product and visit producers in India to determine the type or quality of the products according to international standard. As far as pre-MLI was concerned, purchase activity was actually not taxable at all. Our domestic law would exempt this if this purchase activity was done for the purpose only of export. So if this purchase activity was done for purchase of raw material and then there was finished goods made and that was sold outside, then there would have been no question. But supposing that is not the case, you don't know where the goods are sold. Then, as far as post MLI scenario is concerned, this purchase exclusion is actually diluted. And if the purchase is really a core function, right, then it does not remain preparatory or auxiliary, and purchase office may constitute a permanent establishment in India if there's an essential function. So really one will have to look at facts and circumstances of each case and then take a decision as to what would happen. Let's take one more example. There is a bank, there's a foreign bank. It has various branches in India, right? And all these branches grant loan to customers in India. There's also an office of the bank in India which basically does verification of the identity, the KYC of the client, right? And what happens is that the employees of this verification or KYC office actually transmit the information back to the head office, who then relays the information to the branches and says, okay, you can really, this credit worthiness of this person is fine or not fine. And therefore you can grant loans or grant loans at higher rate of interest or don't grant loans to this particular person situated in India. Now, what happens in this situation? In a normal scenario, what you would say is that I am only doing a verification function. It's a very back office function. It's a very auxiliary function. The key function really as far as loan is concerned is granting of the loan. That is being done by India branches. India branches are already paying tax as far as their accounting profit is concerned or their taxable income is concerned. Therefore, there should be no further attribution of the income of the verification office, and presume the verification office is remunerated at some cost plus, right? Then you would say that this is an independent operation, nothing doing, no combination. and therefore there is no question. Now, after MLI, the situation changes. The activity of the branch and the activity of this verification office actually become part of a cohesive business operation. Because unless you know the credit worthiness of your borrower, you will never be able to lend to him. And therefore, the function that the verification office conducts is a complementary function. So, therefore, if this verification office belonged either to the bank or to a closely related enterprise, it would still not make a difference. The profits of that verification office would have to be taxed in the hands of the Indian branches of the bank. Why? Because this verification office is sitting in India. But presume this verification office were to be located in Sri Lanka. Then there would be no question of attribution because the two activities are not carried out in the source state itself. So one has to be little careful in terms of how one interprets this. Right? Now, in this context of these 5 case studies, let us look at one case of RGA International Reinsurance Company. Now, the taxpayer was a tax resident of Ireland and was in the business of reinsurance. In India, there was no presence of the taxpayer at all. Through brokers, the taxpayer had entered into various insurance treaties with Indian insurance companies for underwriting risks for which it received reinsurance premium. And these were independent third party brokers like JB Boda, KM Dastur, Marsh, all of those. The taxpayer also signed a reinsurance support service agreement with an Indian subsidiary, not a subsidiary of its own, a subsidiary of a group company called RGA Services India Private Limited, by which the subsidiary provided business support, underwriting and actuarial support, risk profiling, data synopsis, etc., etc., market research, CRM, and administrative assistance to the taxpayer. These services were also provided by the subsidiary to the other companies of the RGA group. So RGA is only a reinsurer, so it does only reinsurance business. Other foreign companies undertaking reinsurance transactions with other foreign cedents were also using this services of the subsidiary. Taxpayers' assessment was concluded with the department's allegation that the taxpayer had a fixed place P and a dependent agent P under Article 5(7) of the India Ireland DTAA. Now, India Ireland DTAA contains a clause where if you collect insurance premium in India, then you are deemed to have a permanent establishment, to which reinsurance is an exception. So, if you collect reinsurance premium in India, you don't have a P. But if you collect insurance premium, right, you would insure Indian lives directly and you collect premiums in India, then even though the premium would be collected through an independent agent, there would be a PE. There's a specific article in the Ireland Treaty. So department applied that to say that nothing doing, the moment you collect premium in India, you have a PE. And there were certain other allegations also. Assessing officer looking at the modified definition of the PE held that the Indian subsidiary becomes the PE of the taxpayer since the services rendered by the Indian subsidiary constitute complementary functions that are part of a cohesive business operation. Now, what the tribunal held is number one, that the Indian subsidiary does not constitute a fixed place and a dependent agent P relying on the decision in the earlier years. So what the tribunal said is that in order to be an insurance agent, you need to have permission from the IRDA to act as an insurance agent or an insurance broker. Since you are not acting as an insurance agent or an insurance broker at all, there should be no question of you having a agency P. Regarding MLI, what the tribunal held is that Article 13 has introduced a new paragraph to Article 5 of the India Ireland Treaty AA in order to prevent an enterprise of a group or closely related enterprise from fragmenting a cohesive business operations into smaller operations to argue that each is merely engaged in preparatory or auxiliary activity. This new paragraph applies to two types of cases. One, where the non-resident enterprise or a closely related enterprise already has a PE in the source country, and the activities in the question constitute complementary functions but are part of a cohesive business operation, and where there is no existing PE, but the combination of activities in the source country by the non-resident enterprise and the closely related non-resident enterprise result in a cohesive business operation that is not merely preparatory or auxiliary in nature. So therefore, in this case, there was no PE at all. And also there were no two activities or two enterprises which carried on activities in India, right? So the first condition for an enterprise to enter into the non-exemption category is to have a fixed place used or maintained by an enterprise in the same place or any other place in the same state where the enterprise or its closely enterprise carries on business activities. That is, me, the taxpayer, and the closely related enterprise need to carry on business activities in India, and that the activities carried on in India should result into a cohesive business operation. The taxpayer, which is into reinsurance business, does not have business operations in India. It has business operations with India. It collects premiums from Indian cedents. It's a business operations with India, not in India, for the reason that the acceptance of risk, and this is very important, the acceptance of risk, which is the key function of the reinsurance business, is assumed outside India by the taxpayer. The taxpayer does not have any branch or presence or premises in India. Accordingly, taxpayer and the Indian subsidiary are not carrying on business activities which constitute complementary functions and are part of a cohesive business operation. This was the only decision that I found which was, on Article 13. And, this was a decision which, at least, I found to be quite logical. I found it to be quite balanced in terms of interpreting of the MLI. So I thought I'll share that with you. We come to the last part of our presentation. I'm aware that we only have 10 minutes. We'll hopefully try and finish by the time that we are allotted. We come to Article 14, which is splitting up of contract and the anti-abuse rules in regard thereto. Now, if we look at construction Ps typically, what is actually covered is a building site, a construction project, and an installation project. OECD models looks at all of these three. In addition, the US and the UN Model Convention also look at an assembly project and supervisory connection activities in connection therewith, which is the building site, construction project, installation, or assembly project. All of this are looked at as far as PE is concerned. And of course, service PE is also looked at. If all of these activities get carried on in India, beyond a particular threshold, the duration which will be different in different model conventions, 12 months in OECD, 6 months in UN, and 120 days in the US, then there will be a PE if the threshold is breached. So if these activities are carried on for more than 12 months, as far as a treaty which follows OECD model convention is concerned, then there will be a PE. If they are carried on for more than 6 months in a treaty where, or by a country which follows UN model, or 120 days as far as US is concerned, then a PE is constituted as far as the non-resident is concerned. Indian treaties generally have a lower threshold of 6 to 9 months, and for service P, it's 90 and or 120 days, and for related enterprises, again, a 30-day or even a 0 day as far as US is concerned. So what people do is that they break up the activity into this, and they break up the activity in terms of the sequencing also. So if there are activities to be carried on, different enterprises belonging to the same group will carry on these activities in a different sequence, and they will try and split this up. And therefore, this is something that Article 14 of the BEPS action plan of the MLI, sorry, seeks to curb. So really, if you look at, this scenario, there is ARCO, ARCO has won a bid for the construction of a power plant for ESCO, right? Presume ESCO is in India. There is a timeline of 22 months for completion of the project. Okay. Now, sorry, ESCO is the subsidiary. I'm so sorry that ARCO has, this thing paid bid for the power plant of ESCO, and that it has a subsidiary in ESCO. The contract is split between ARCO and ESCO. And the condition of the contract says that ARCO and ESCO are still jointly, and severally liable. As far as the holding and the subsidiary company are jointly and severally liable, and the activities are split up between ARCO and ESCO. Then, really, how do you look at the duration test? Should you look at the duration test as a combined activity? Should you look at the duration test as the total activity? And typically what happens is that you will have ARCO carrying out a certain activity, then it will hand over to subco will carry out a certain activity. So you will have 11 months, which is less than the OECD limit of 12 months as far as the activities are concerned. And OECD really noticed that domestic and judicial anti-avoidance rules in countries, including India, were not sufficient to address this issue of the artificial splitting off of the contract. And therefore, paragraph 17 of Part C of Action Plan 7 addressed the splitting up of contract. It recommended adoption of any of the two following measures. One is obviously look at the principal purpose test. So, what was the purpose of splitting up of the contract into two separate pieces? Really, was the purpose only to save yourself from the tax that arises on the constitution of a PE? Or was the purpose something which was actually genuine, that your first company, in our case, ARCO, did not have the requisite manpower or the expertise to do it? The subco or ESCO really had it, and therefore the contract was split. So, was there a commercial reason for splitting up of the contract into two different pieces? If there was, then yes, there is no P. Otherwise, you will be. And the other one was incorporation of a specific provision in the treaty, which basically was adopted by India to say that if there are complementary activities carried on by two different enterprises of the same group, then really the period would be combined and not looked at individually. Now, Article 7 of the MLI, in that sense, the principal purpose test is a minimum standard. Obtaining the tax benefit is one of the principal purposes. Results directly or indirectly in the benefit arrangement or transaction is, you know, including establishment, acquisition, and maintenance. Exclusion of the object and purpose of the treaty you will have to look at. And once you are clear that the object of the treaty is not to grant you the tax benefit, then you will have to look at. And over and above, the limitation of benefit test is what you will have to look at. So case by case, one will have to look at. If you apply PPT, it's a very subjective test. And therefore, again, you don't want to get into litigation. India says, forget all this. I don't want to get into litigation on PPT. I will say that if there is a fragmentation of the contract, for the purpose of calculating the threshold, I will just aggregate the two periods. So, what does Article 14 say? The enterprise must carry on activities including supervisory or consultancy activities at a building site, construction project, installation project, or any other specified activity in the source country for a period exceeding 30 days in aggregate, but less than the prescribed date to constitute a PE. So, if my activity itself is less than 30 days, then there's no question. But if I carry on activity of more than 30 days, right? But this is less than the prescribed days to constitute a PE. And connected activities are carried on at different times by one or more closely related enterprises at the same project site or at any other place identified in the relevant tax treaty for a period exceeding 30 days again, right? So there's the 30-day threshold for me. There's a 30-day threshold for a connected enterprise, right? Then the time periods under the two clauses would have to be added to determine the number of days the first enterprise, who's the main contractor, has carried on activities at the same project site. So even if the second enterprise, which is the connected activities, are carried on by different enterprises at a different place, but if they are connected, the activities are connected, then I will have to combine the activities which I carry on as well as my associated enterprise carries on. And applicability of Article 14(1) hinges on the carrying on of connected activities by closely related enterprise, right? That is very clear, as we saw. Now, the fact that connected activities have been carried on at different points in time is inconsequential. So somebody might say that, okay, I am carrying on activities for say 2 months. There is a gap of 1 month after which the other enterprise carries on its own activity. Is that not sufficient for you to say that there is no PE? Because it's not an immediate handover. It's not that, me leaving a particular activity at a particular stage and immediately handing it over to my associated or connected enterprise. They say that the fact that these are carried on at different points in time is absolutely inconsequential. There's no question. There's no overlap with the period of the main enterprise. And irrespective of the time period, the time spent by closely related enterprise on connected activities would have to be aggregated with the time spent by the contractor, except the one which has been carried on for less than 30 days. So let's look at some illustrations. For example, if I am the main contractor, I carry on a certain activity for 125 days. There is connected enterprise number one or closely related enterprise number one, which carries on activities in the source country for 40 days. There is a second connected activity on which the time which is spent is 35 days. Then the total of 125 plus 40, 165 plus 35 will have to be aggregated, and 200 days will be the time that would be spent on these activities. And therefore, there would be a existence of a construction PE as far as the MLI is concerned. Take a second scenario where contractor spends 125 days. A closely related enterprise spends 40 days on activity 1, 30 days on activity 2. Then this 30 days on activity 2 has to be excluded because for each activity you have to have a minimum threshold of 30 days. So as far as the P threshold calculation is concerned, it will only be 125 and 40, which is 165, which will not be more than 183, and therefore there will be no PE. Same way, main contractor does only 30 days, right? There's 91 days and 70 days for connected activity 1, connected activity 2. Again, this is only 91 plus 70. There will be 161 days. The first main activity or main contractor's activity, which was less than 30 days, has to be excluded and therefore no PE. But if God forbid this becomes 31 days, right? 31 plus 91 plus 70 will result in 192 exceeding 193. So really one will have to be very careful if one has to even plan splitting of the contract, right? Now, what are connected activities? What usually does one look at when one says that two activities really are connected, right? One, whether the contracts connecting the different activities were concluded with the same person or related person. Two, whether the conclusion of the additional contracts with that person is a logical consequence of a previous contract concluded with that person or any related person. Three, whether the activities would have been covered by a single contract absent tax planning considerations. Four, whether the nature of work involved under the different contracts is same or similar. And fifth, whether the same employees are performing the activities under both these contracts or both the activities. So it is really a question of fact. Facts will decide whether the activities are connected or not. One will have to be very clear. Some treaties where splitting up provisions were always there, right? And are there already. So Netherlands, Australia, Ireland, New Zealand are there. But there are certain illustrative treaties where splitting up provisions are not there. Again, these are opt-in provisions. So France, UK, Singapore, Japan do not have these provisions. We'll skip the case study. I think we've understood this. So let's not kind of go into this. Uh, let's look at one or two case laws on permanent establishment. I want to establish, just the principle as far as those two case laws are concerned. One is a very interesting decision of the Delhi High Court, full bench in Hyatt International. And the issue really was that if the enterprise as a whole incurs a loss, right? Should there ever be an attribution of permanent establishment to the enterprise as far as India is concerned? And really, there was a decision of the special bench in Motorola, followed by a decision in Nokia, which basically said that if there is there's a decision of the Delhi High Court in Nokia, which said that if there is a loss which is incurred globally, then there's no question of attribution of income to a permanent establishment. Now, there are several provisions in our law itself, right from 1922 Act, judgments under 1922 Act, Rule 7 of our income tax rules, which somewhere seem to be not in sync or in rhyme with that proposition. That if there is a loss globally, nothing can be attributed to India. I think Indian domestic law also always has recognized the proposition that as far as attributing income to operations carried out in India is concerned, you look at only the uh, operations that are carried out in India standalone. You do not look at operations that are carried on globally. And if that is the case, then if the operations in India standalone result in a profit, then that profit will have to be offered for tax in India. The Delhi High Court really has upheld that proposition today. And we could have gone on to discuss a lot more, but I do realize that I am out of time. So we'll not kind of discuss that. But it's a very interesting, case study to kind of look at. That ultimately, even India as a country, even in the good old days, never accepted that proposition. And therefore, you know, with all due respect to the special bench and the division bench of the Delhi High Court, I think this decision of the full bench actually reiterates the proposition, and I believe, hopefully should settle that issue at least. Next one is Progress Rail Locomotive. And question was really there was a taxpayer who was a US resident and was supplier of related, railway related equipment to the railways. And it had a wholly owned subsidiary in India. And in a survey, the assessing officer, it issued notices alleging that there was a PE under 148. Okay. Now, High Court really said that really there is no fixed place at all because the premises of the subsidiary were under the exclusive control or disposal of the subsidiary and they were not under the control of the taxpayer. So if there is a limited access to that premises for some particular purpose, then really that does not mean that the subsidiary is your permanent establishment and you have a fixed place PE, right? A subsidiary would only become an alter ego if and a virtual projection as used in Visakhapatnam Port Trust. 144 ITR 146. It would become a virtual projection or an alter ego only and only if it is found on fact that that subsidiary had no independent existence or business activity of its own, and it is only working to subserve the business of the parent in that sense. And in this case, very clearly on facts, it was found that the subsidiary was undertaking activities independently and its own right, were making its own decisions and making its own income, and therefore there was no question of P. Okay. Again, there was representatives on the board of the subsidiary would not really mean that APE would be coming into existence, right? The reporting to foreign personnel was only to ensure compliance with the global best practices of the group company. Performance evaluation of the employees of the Indian subsidiary was undertaken by the functional heads present in India, who in turn were evaluated by the Indian managing director and the HR department of the subsidiary, though based on the feedback from the foreign manager determined the rating, but the ultimate decision in rating of the employees was of the managing director here in India. Then service P again, the revenues reliance on the India visits of the foreign companies employees, the interaction, etc., etc. Periodic visits were at best recognized as the right of the holding company to oversee, so they really looked at as oversight activities, and there was no agency, so therefore there was no PE. There are some other decisions which we will not go into. With that, let me just end this presentation and thank all of you for such a patient hearing of this session. Happy to take any questions that one has on this.
So there
Thank
are
you.
two questions which are there.
Sure.
One question is that if the non-resident, this is in relation to the conclusion of contracts. So the question is that if the non-resident applies his mind and reviews the suggestions of an agent each time, but then there are no material modifications, he accepts those suggestions or recommendations. Does that still lead to an exposure of agency PE?
So
As
again, it would always be based on facts. I would believe that there should not be a routine acceptance of the decision of the agent. If I look at the wording of the MLI very clearly, there has to be no routine acceptance. If the non-resident does apply his mind and if he believes that the agent has done a good job, then I would believe that there should be, no question of constitution of a P as in that scenario. But you will have to keep documents on record to evidence the fact that there are questioning which has been done. There is an independent decision-making process which has been done as far as the non-resident is concerned.
And so an add-on question to that is that in some cases there could be standard lists or checklists or parameters which are given to the agent who acts within that the bounds of that checklist or authority. So would such a scenario also kind of trigger a PE?
So it depends on what is contained in that checklist. The fact that there is a standard checklist cannot automatically absolve oneself from the constitution of a PE. It is what is the activity that that checklist contains that will be more important as far as the constitution of a PE is concerned. We have Sanjeev Sharma, sir. Sir, welcome. And sorry, I didn't really see you earlier. But pleasure to have you, sir. If you have any thoughts on any of the things that I have said, happy to get some guidance from you.
Thank you. Thank you, Anish. Good evening, everyone. In fact, Anish just joined when you were having the case of Hayat International. Okay. So I think it's a very good presentation, whatever I could make out. And I think that I have as of now, no add-on on that. Thank you very much.
So, but would you agree, that Hayat was always the case, and the law always was what it was. You didn't really need Hayat to say it. Unfortunately, Nokia was something which was not really in consonance with that principle.
Yeah, no, Anish, you are very right, because if we look into that, the permanent establishment, the profitability needs to be really looked into independently. Okay. And because when the case of Nokia was given, it was really long back. Okay. And based on the particular facts of the cases and all that, I think they looks like the ITAT got motivated or by assuaged by whatever was argued before them. by saying, and that time because we used to really apply Rule 10 also. Okay. So if there is a profit and we are unable to really work out the profitability, then based on the global profit, in many cases we worked out, even the tax administration worked out in many cases. Okay. Looking to the global profitability and then allocating based on the revenue, what revenue is generated from India. Okay. But certainly that whenever there is a loss, certainly there is a issue that loss is because of the activities in India, or this is because of somewhere else that loss is happening. Because if that analysis is done very properly, okay, that India also contributes to those losses which have been global losses, then might be the issue might be different. So it's all factual analysis. Neither this side or that side, I think, is a permanent establishment. Attribution of profit is facts based.
Absolutely right, sir. I think Rule 10 really, in a way, is a residuary computation where you can't have a better computation, right?
Yeah, certainly.
Much appreciated, sir. Thank you so much for joining, and really honored to have you on.
Thank you very much.
Back to you, Kush.
Yeah, you can close this session before Sanjeev sir's session.
Thank you so much, sir, for taking us through wonderfully in terms of the permanent establishment, the cases, and the MLI implication. It was really appreciated. And thank you for sparing your time. So I would just like to extend a hearty vote of thanks on behalf of IFA WRC for sparing your time. Thank you so much.
Thank you very much. Really appreciate it. Have a good evening. And sir, looking forward to your session.
Thank you very much. Thank you, Anish.
I'll stay on for some time, sir, for your session.
Please find time, whatever you can.
Sure, sir.
So we'll start with Sanjeev sir's session. Sir, if you can share your presentation.
Let me just wait. Yes, please. Yeah.
Sir, if you can just, put it in the slideshow mode so it will be visible.
Yes.
Okay, thank you, sir. So I'll just introduce Sanjeev sir. So Sanjeev sir is an independent tax consultant who also works as a special advisor to the government of European country under the UNDP OECD Tax Inspector Without Borders program. He worked also as an advisor in the OECD Secretariat in Paris from 2010 to 13 and was instrumental in the OECD's work on tax transparency, information exchange, and removing the banking secrecy for tax purposes. And he has done or spent most of his career dealing with the taxation of MNEs in the areas of transfer pricing and international tax. He was APA commissioner in Delhi for about 6 years, and the International Tax Review has declared him the Asia Pacific region's tax official of the year 2021. He has also been awarded Anubhav Award 2024 by the Government of India for his incredible contribution to the government service. So we are very happy to have you, sir, and looking forward to your session.
Thank you, Prerna, for your kind words. Are you able to hear me properly? Can I start now?
Yes, sir. You can start, please.
Okay. Thank you very much. Thank you. So good evening, everyone. I'm very happy that I'm here. And thank you, IFA WRC chapter, for inviting me to deliver this session. And I'm very happy to be here. Okay. So without wasting time, I think, and Prerna, if you are unable to hear or some problem because of connection, then please let me know. Okay.
Sure, sir.
Yeah, please. Yeah. Thank you very much. Yeah. So this presentation covers double taxation and non-taxation caused through hybrid entities and hybrid financial instruments. A brief introduction to BEPS Action 2 report, Then Article 3 of MLI that deals with the transparent entities and Indian position on that. Article 11 of MLI, rights to tax own residents and Indian position on that too. Then Article 4 of MLI, dual resident entities and Indian position. Then case laws on hybrid instruments and entities. And I have also included Article 5 because, that is because Article 3, 4, and 5 go together. I've included, might be somebody else is dealing with it during all the sessions, but I'll just try to touch it also. So starting with the neutralizing effects of hybrid mismatch arrangements. Prior to that, I would like to say that as all of us know, there are two types of double taxation which is possible. One is the economic double taxation, and the second, so economic double taxation happens when same income is taxed in the hands of two entities. And other one is juridical double taxation when the same income is taxed in the hands of same entity in two jurisdictions. So to avoid these taxations, juridical and economic double taxation, so in case of economic double taxation, Article 9 provides for the corresponding adjustments. And in respect of the juridical double taxation, there are tax treaties, the main purpose of which is to avoidance of double taxation. And whenever suppose this avoidance of double taxation was certainly it has been the main function of the tax treaties, but lately because there has been non-taxation or the tax avoidance or tax evasion, then the purpose of tax treaties is also moving into the other direction also, and which happened because of the BAPS projects. So if we look into that, as far as the double taxation is concerned, that is being taken care of. What about the double non-taxation? For example, if we take a very simple example, that let us entity in a parent in some other country has given a loan to a subsidiary in India, and that interest is being paid on that loan. So interest is being claimed as deduction by the Indian subsidiary, but the other entity in the other country that treats this income stream not as interest but as dividend, and might be because of their participation exemption regime or some other regime, that dividend is not taxable in other country. Okay, so what happens that because of the tax treaty, it is leading to double non-taxation in the sense because here in India that interest is being claimed as deduction, and in the other country the corresponding income is not being offered to the taxes, and that is so this is called mismatch. Okay, so this is like the income stream mismatch. Then there can be mismatches because of the entity also. All of us know that like partnerships or trusts, they can be transparent entities, fiscally transparent, that the entities themselves are not subject to tax, but their beneficiaries or partners are subject to tax. So might be the one jurisdiction treats that partnership itself or firm itself as a taxable entity, and the other jurisdiction treats that beneficiary or the partners as taxable entities. So this also leads to the mismatches, and this is entity-based mismatches. So there have been a lot of studies by the OECD, and because of course, India was not that much advanced as far as the international taxation is concerned earlier, but other countries like developed world have faced these problems. And so because of keeping this in mind, that when the BEPS project started, then the Action 2 that was specifically devoted to this, what we call the neutralizing effects of hybrid mismatch arrangements. So when this report was published in October 15, along with the other reports, then as we know that Action 15 provided for the MLI, and the MLI to take into account all the recommendations which have been made. And which can be very expeditiously those can be implemented in different countries without going for the renegotiation of tax treaties and all. That was the purpose of MLI. So part 2 of MLI, that is Articles 3 to 5, those deals with the hybrid mismatches. And those introduces provisions which aim to neutralize certain of the effects of hybrid mismatch arrangements based on the recommendations made in final reports for BEP Section 2, that is neutralizing the effects of hybrid mismatch arrangements, and Section 6, preventing the granting of treaty benefits in inappropriate cases, circumstances. And these two reports were released in October 15. The provisions cover, because these provisions cover hybrid mismatches related to transparent entities, that is Article 3 in the MLI, dual resident entities, Article 4, and elimination of double taxation, Article 5. So all these Article 3, 4, 5, all taken together takes care of this hybrid mismatches as far as the treaties are concerned. That whenever suppose non-taxation or under-taxation is happening because of the tax treaties, then these provisions should take care of that the tax treaties do not encourage this non-taxation. These provisions are not minimum standard provisions, and therefore contracting jurisdictions have the right to opt not to apply these provisions to their covered tax agreements. As all of us know, there are 4 minimum standards which all the inclusive framework members were committed to implement. And that is those were arising from the Action 5, Action 6, Action 13, and Action 14. I'm not going into detail because of the time limitation. Then salient features of BEPS Action 2 report, that is neutralizing the effects of hybrid mismatch arrangements. Frankly speaking, this is excellent report, and all of us who are participating in this today's session, whenever please find time, please go through that. It is an excellent report. So hybrid mismatch arrangements exploits differences in the tax treatment of an instrument, what we discussed, like income stream or entity under the laws of 2 or more jurisdictions to achieve double non-taxation, including long-term deferral. So double non-taxation we have already discussed with one example, and long-term deferral can be that that income stream is allowed as deduction in one country, let us say in India, like payment of royalty or payment of the interest and all, and in the other country that is not taxed till it is received on payment basis. So that is, if that is continue to accrue in India, of course we allow deduction, but will not be taxed in other countries. So this also, hybrid mismatch arrangements also lead to that long-term deferral also, that is possible. Then BEP Section 2 reports provides recommendations regarding the design of domestic tax rules and the development of model treaty provisions that would neutralize the tax effect of hybrid mismatch arrangements. So it attacks this mismatch arrangements on domestic as well as tax treaty front. Then Action 2 reports has 2 parts. Yeah. So part 1 contains, is more than 500-page report, as I said. So part 1 contains recommendations for changes to domestic law, and part 2 sets out recommended changes to the OECD Model Tax Convention. The report states that the purpose is that once these recommendations are implemented, they will put an end to multiple deductions for single expenses, because what happens, one expense in one country may lead to deductions in different countries. That is called multiple deductions, double deduction, triple deductions, like that. Then deductions without corresponding taxations. In one country, there is a deduction, but in other country, the income is not taxed. Or the generation of multiple foreign tax credits for one amount of foreign tax paid. So tax is paid in one country, but the deductions or the credits can be claimed in multiple countries. So then if we look into the domestic tax, if any changes are to be made to the domestic tax, then the respective country need to amend or change its domestic law to account for this. But as far the tax treaty is concerned, that we have MLI, we have already seen. So domestic tax, what the recommendation for domestic tax are? Of course, there are many recommendations, but I've just tried to give a very brief idea of that. That is primary rule. Countries deny the taxpayer's deduction for a payment to the extent that it is not included in the recipient's taxable income in the counterparty jurisdiction, or it is also deductible in the counterparty jurisdiction. So what is the primary rule? The country which is making payment, and if the deduction is being claimed for that, let us say interest, then the deduction should be disallowed if the recipient entity in the counterparty jurisdiction is not offering that income to tax, or it is also claiming a deduction for that. So this is primary rule. And secondary rule is, if the primary rule is not applied by the paying country, then the counterparty jurisdiction, that is other country, can generally apply a defensive rule, requiring the deductible payment to be included in income or denying the duplicate deduction depending on the nature of the mismatch. The report sets out a common set of design principles and defined terms intended to ensure consistency in the application of the rules. Because what happens, because if all the countries implement the domestic law for primary rule, somebody does with the defensive rule, then it might create a double taxation also, or double non-taxation again. So this is design principles are set out in the report, and those design principles need to be looked into by a country while amending its domestic law. Example of recommendations, that is recommendation 1, neutralize the mismatch to the extent the payment give rise to a D means deduction and NI means non-taxable income. So if it is outcome like that, then the same rule, I think this is just what I have written in, what I have stated in brief. This is a rule, particular recommendation. The following rules should apply to a payment under a financial instrument that results in a hybrid mismatch, and to a substitute payment under an arrangement to transfer a financial instrument. So financial instrument is defined, and substitute payment is also defined in the rules or in the report. The payer jurisdiction will deny a deduction for such payment to the extent it gives rise to deduction or non-taxable outcome. This is primary. Then if the payer jurisdiction doesn't neutralize the mismatch, then the payee jurisdiction will require such payment to be included in the ordinary income to the extent that the payment gives rise to a deduction or non-taxable outcome. So this is defensive rule. Difference in the timing of the recognition of payments will not be treated as giving rise to a deduction or non-taxable income. Outcome for a payment made under a financial instrument, provided the taxpayer can establish to the tax satisfaction of a tax authority that the payment will be included as ordinary income within a reasonable period of time. Okay, so this is accrued and that is not received over there, not offered to income. In that case, the taxpayer need to justify to the satisfaction of tax authority that this will be done in a reasonable period of time. Then definition concerning recommendation 1. What is financial instrument? A financial instrument means any arrangement that is taxed under the rules for taxing debt, equity, or derivatives under the laws of both the payee and payer jurisdiction, and includes a hybrid transfer. And hybrid transfer is also defined. A hybrid transfer includes any arrangement to transfer a financial instrument entered into by a taxpayer with another person. Okay, so that is a financial instrument they have entered into where the taxpayer is the owner of the transferred asset, and the rights of the counterparty in respect of that asset are treated as obligations of the taxpayer. So taxpayer in one jurisdiction claims that this asset belongs to me, and I am the owner of this asset, and I am also responsible for the obligations. Under the laws of the counterparty jurisdiction, means other jurisdiction, the counterparty is the owner of the transferred asset, and the rights of the taxpayer in respect of that asset are treated as obligations of the counterparty. So same asset, same transaction that is being treated by it is owned by both. That is hybrid transfer. Recommendation 2 is specific recommendations for the tax treatment of financial instruments. This is very important because this is the main crux of the all recommendations for the financial instruments. Denial of dividend exemption for deductible payments to prevent deduction or non-taxable income outcome from arising under a financial instrument. A dividend exemption that is provided for relief against economic double taxation should not be granted under domestic law to the extent that dividend payment is deductible by the payer. Okay, so if the dividend, so what is this? It is saying that if there is a financial instrument and there is a interest is being paid by, let us say, in A country, and that stream is being treated as a dividend in other country, then a dividend exemption that is provided for, because there's a dividend exemption is provided in other country, but that should not be granted under domestic law of that country to the extent that dividend payment is deductible by the payer, because the payer is claiming this dividend payment as interest. Okay, so if that is being claimed as interest, then the other countries should not exempt this dividend income. Equally, jurisdictions should consider adopting similar restrictions for other types of dividend relief granted to relieve economic double taxation on underlying profits. And this is one of the example which is given in the report. That's called example 1.1, interest payment under a debt equity hybrid. And this is as I said, that this is really used worldwide in the cross-border situations. So in this case, the company A is in jurisdiction A, and company B is in jurisdiction B, and company B is wholly owned subsidiary of company A. Okay, it is holding, because it is holding more than, it's a wholly owned subsidiary. Company A gives a loan to company B, and company B pays an interest to company A. What happens? The company B subsidiary, when it is paying the interest, it is claiming as deduction from its profit. Whatever in the business accounts, it is claiming deduction. What that dividend, because that is being considered, it is interest in country B or for the company B, but that same is being treated as dividend in A country, considering that whatever loan has been given, that loan is of the nature in equity. Once it is equity in nature, so whatever is received back out of for that is dividend. And because there is a participation exemption in country A for company A, because the holding of company A and company B is more than 10%, let us say they have a threshold of 10%, then the dividend received is exempted from taxation. So in company B, it is claiming as interest deduction, but in country A, the company A is claiming that dividend received as exempted. And this is to this situation, the primary and secondary rule will apply. I'm not going in detail because of, as I said, already time constraint. Now, part 2 of the recommendations, and these are the recommendations which has come into MLI. Recommendations for modifying tax treaties. Recommendations aimed to ensure that hybrid instruments and entities and dual resident entities are not used to obtain unduly the benefits of tax treaties. Report proposes that cases of dual residence under a tax treaty would be solved on a case-by-case basis, and we'll see the competent authority agreement little later, rather than on the basis of the current rule based on the place of effective management of the entities. Presently, what happens that when there is a dual residency of the entity, then under the tiebreaker rule for the entities which are other than individuals, that it is considered whoever is having the place of effective management, and that country is considered that means that entity is considered to have resident of that country. This is changed now. I will discuss later on. Report also deals with application of tax treaties to hybrid entities that are not treated as taxpayers by either or both that have entered into a tax treaty. So these are fiscally transparent entities that also is dealt with this part 2. Part 2 recommendations for tax treaties in a new provision in the convention and commentary to ensure that benefits of tax treaties are granted in appropriate cases to the income of these entities, but also that these benefits are not granted where neither state treats under its domestic law the income of such an entity as the income of one of its residents. So if that is not taxing that income, because we go by the concept of liable to tax, if the income is not liable to tax, then that is not considered a resident. Tax treaties would generally not prevent the application of domestic rule proposed in part 1 of the report. So domestic rules, if any country is implementing domestic rules, suggestions which are made in the report, then this treaty, tax treaties will not prohibit or prevent that application of domestic rules. And now we come to our actual presentation, that is Article 3, transparent entity. So fiscally transparent entity. This is in the multilateral instrument. So as I said that none of these articles like Article 3, 4, 5 or even 11, those are minimum standard, but these are optional provisions that the jurisdictions will be free to make reservations or not to apply those articles in their, not to agree for those articles in their tax treaties, covered tax agreements. This provision addresses the situation, that is Article 3, of hybrid mismatches as a result of entities that one or both contracting jurisdictions treat as wholly or partly transparent for tax purposes. Yeah, like partnerships, trusts, CIVs, and all that. Tax treaty benefits to be allowed to fiscally transparent entities for the income earned to the extent that such income is taxed in the jurisdiction in which the entity is resident. So this is the main principal focus of the Article 3, that the benefit of the tax treaty will be allowed to the extent the income is taxed in the jurisdiction in which the entity is a resident. Provision to apply in place of or in absence of HBC, the MLI is having different type of provisions, whether in place of means is a substitute, or in the absence of means there is a gap, there is nothing in the tax treaty, and this will be inserted. And there are various paragraphs, so I'm just reading the paragraph. That paragraph 1 of Article 3, for the purpose of covered tax agreement. All of us know what is covered tax agreement. Then a covered tax agreement is an agreement which is considered by a jurisdiction to be covered by the provisions of the MLI. Okay. So as like India has given 93 agreements as its covered tax agreement, I'll discuss little later of this issue. So for the purpose of a covered tax agreement, income derived by or through an entity or arrangement that is treated as wholly or partly fiscally transparent under the tax law of either contracting jurisdiction shall be considered to be income of a resident of a contracting jurisdiction, but only to the extent that the income is treated for the purpose of taxation by that contracting jurisdiction as the income of a resident of that contracting jurisdiction. Okay, so we are talking of fiscally transparent entities. Okay, in one country, either in one country or both countries, that can be considered as a fiscally transparent entity. And that is treated as wholly or partly fiscally transparent under the tax laws of either contracting jurisdiction. Means in one jurisdiction, it is a opaque entity, means it is taxed as such, but in other jurisdiction, it is fiscally transparent. In that case, the country for which it is considered as resident, the benefit of tax treaty will be given to the extent of income which is subjected to tax. Okay, to the extent that income is treated for the purpose of taxation by that contracting jurisdiction. Then paragraph 3.2, provisions of covered tax agreement that require a contracting jurisdiction to exempt from income tax or provide a deduction or credit equal to the income tax paid with respect to income derived by a resident of that contracting jurisdiction. So we are talking of the avoidance of double taxation as we generally have in Article 23 of the tax treaty, that a country can give the avoidance of, can provide for avoidance of double taxation by either exempting the income or giving the credit of the taxes paid or deduction for the income tax paid. If that is the situation, which may be taxed, and this is also taxed in other contracting jurisdiction, and that this credit or deduction is to be given, then according to the provisions of the covered tax agreement, that shall not apply, means this exemption, deduction, and credit will not apply to the extent that such provisions allow taxation by that other contracting jurisdiction, let us say source state or whatever, solely because the income is also income derived by a resident of that other contracting state. So other contracting state also treats that entity as a resident. In that case, once it is treated as a resident, in that case, then the deduction, credit, and all that will not be allowed. Then 3.3. With respect to covered tax agreements for which one or more parties have made a reservation described in Article 11, paragraph 3, that we will discuss later on, that application of tax agreements to restrict a party's right to tax its own residents, then they say that in paragraph 1 also include this one. If they have someone has that jurisdiction has made a reservation, that to account for that reservation also. In no case shall the provisions of this paragraph be construed to affect a contracting jurisdiction's right to tax the residents of that contract jurisdiction. So that is means the jurisdiction can tax its own residents, and those provisions will not affect its rights to tax. Paragraph 1, as it may be modified by paragraph 3, shall apply in place or in the absence of a provision of a covered tax agreement. So if there are provisions already, then those will be substituted, or if there are no provisions, then those will be introduced, to the extent that they address whether income derived by or through entities or arrangements that are treated as fiscally transparent under the tax law of either contracting jurisdiction, whether through a general rule or by identifying the treatment of a specific fact patterns and type of entity, shall be treated as income of a resident of a contracting jurisdiction. So this is the effect, how this will be done and what will be the effect. A party may reserve the right, paragraph 5, for the entirety of this article not to apply to its covered agreement. That is one. And so such type of compatibility clauses regarding the reservation and how that will affect, that are in respect of all the articles. So this is also provided here. Paragraph 1 not to apply. So okay, what a contracting jurisdiction can do, that it can say that this article doesn't apply to its covered agreement at all. It just say no to this article. Then paragraph 1 not to apply to its covered tax agreement that already contain a provision described in paragraph 4. Okay, whatever is here, if that is already stated in that covered tax agreement, then there is no need to apply that again, to superimpose that. Paragraph 1 not to apply to its covered tax agreement that already contain a provision described in paragraph 4, which denies treaty benefits in the case of an income derived by or through an entity or arrangement established in third jurisdiction. Okay, because if there is a more restrictive or clauses already there in the tax treaty that third country entities will not be given a tax treaty benefit, then that will remain. Then a paragraph 1 not to apply to its covered tax agreement that already contain a provision described in paragraph 4, which identifies in detail the treatment of specific fact patterns and types of entities and arrangements. If there are detailed facts pattern based on this, which the benefits of the tax treaty will be given, then that will the country will say no, those will remain, and I don't apply these provisions to that treaty. Paragraph 1 not to apply to its covered tax agreement that already contain a provision described in paragraph 4, which identifies in detail the treatment of specific fact patterns and type of entities and arrangements, and denies treaty benefits in the case of income derived by. So this is also similar to what we saw in C and D. For paragraph 2 not to apply to its covered tax agreement. So it's a paragraph 2 will not apply. For paragraph 1 to apply to only its covered tax agreement that already contain a provision described in paragraph 4. So it is giving various types of options to the tax to the jurisdictions for the application of this Article 3. Because this is not a minimum standard, not covered by the minimum standard. Therefore, because many countries in the world, they already have these provisions in the tax treaties with many countries, and if they want to continue with those tax treaty, then they have a choice of continuing with those provisions and not to apply Article 3 to those covered tax agreement. Then this is when if someone has not made a reservation in A or B of paragraph 5, then they need to give that which paragraph, which article of a particular treaty is covered by these provisions, and that need to be submitted to the OECD the Secretariat for that, who are the custodian for this one. That and these arrangements, as we see that OECD is maintaining a tax treaty database based on this matching arrangements they are doing. If we can go and find out that if we look into the tax treaty of one country with another country and how that this arrangement had changed their position, that one can see online on that one. Then India's position on Article 3. India deposited its ratification instrument with OECD on 25th June 19 with definitive MLI positions regarding 93 covered tax agreements and in respect of all the articles, that what position it has taken for those. So Article 3 in respect of transparent entity, it says that India reserves the right for the entirety of the Article 3 not to apply to its covered tax agreement. Therefore, Article 3 would not modify its covered tax agreement. So whatever tax agreements, 93 agreements are there, that those whatever provisions are there in Article 4 regarding the tax residency, those as such remain. There are no specific provisions particular to transparent entities are included in the tax treaties because of this. What are the implications? India's tax treaties do not generally contain a provision on the treatment of transparent entities except its treaties with the UK and USA. So those only the provisions whatever with the UK and USA, those continue to apply. But other treaties, we just don't give the benefits to the tax transparent entities, or which are fiscally transparent entities. India denies that benefit. A transparent entity not liable to tax in the jurisdiction of its formation or incorporation may not qualify as a resident to avail the tax treaty benefits. So if it is not liable to tax, the entity as such, then it doesn't get the benefit of tax treaty for India. Treaty entitlement for transparent entities will continue to be a challenge in India, because whatever has happened, that because now many type of investment vehicles are there, like CIVs and all that thing. In that case, certainly will be a problem, that because it is not the vehicle which is SPV or vehicle gets taxed, is the beneficiary gets the income. So in that case, whether the benefit of treaty will be given or not, that will continue. So that means Article 3 of MLI doesn't change anything for Indian tax treaties. That is the final thing. As of now, it doesn't change anything for our tax treaties. Then India United Kingdom tax treaty, there is a fiscal residence, that is Article 4. It says that first one is that person who purpose of convention, the term resident of contracting state means any person who under the laws of that state is liable to tax therein by region of his domicile and all that thing. Okay. Then this term doesn't include any person who is liable to tax in the state in respect of only of income from sources. So if somebody is being taxed on the source income only, that based on their taxation of source income, it will not become tax resident of that country. And B is important, that in the case of income derived or paid by a partnership, estate or trust, because these can be fiscally transparent. This term applies only to the extent that the income derived by such partnership, estate or trust is subject to tax in that state as the income of a resident, either in its hands or in the hands of its partners or beneficiaries. So this was a very important development as far as the India-UK tax treaty is concerned. It says that it's not only the entity, but if it is income is taxed in the hands of its beneficiary partners, then that will also get a benefit. To that extent, it will get a benefit of the tax. Same provisions are in the India-USA tax treaty. I'm not repeating. The same provision are there. Then case laws on hybrid financial instruments and hybrid entities. So first case is of the New Zealand Supreme Court. And it says that, because see now what we have seen the financial instruments and we have seen the entities. Okay, so the some case laws deals with the instruments that can be hybrid. It can be considered as hybrid for hybrid treatment. Hybrid means instrument, and the tax treatment will be different. So in the case of convertible notes, these are notes which are converted into shares later on or equal to equity, it was held that hybrid debt is treated as debt before conversion and as equity afterwards when the conversion takes place. There is no policy reason why this should not apply equally to related or unrelated party debt, and nothing in the Act suggests that hybrid instruments are not available between related parties. So this was the justification Supreme Court, because it was said that in case of related party, this will not be done. That was the view of the tax or the position of the tax administration. The Act contemplates a choice between debt and equity, even for related parties. Therefore, until conversion, the $204 million provided to core was rightly treated as debt and interest is deductible. Okay, so what had happened? The tax administration, whatever the money was given, they say it's not a loan, but it is an equity, and because so the interest will not be deductible. I think we get many cases in India also like this, which is only domestic treatment. It has nothing to do with the tax treaty as such. Okay. The second case was Fairfield Development Limited versus DCIT. That is a Hyderabad tribunal decision in 2023. An Indian company issued fully completely convertible FCCDs to its Cyprus-based parent company. Okay, so Cyprus gave a loan to the Indian company subsidiary, and it issued the FCCDs to Cyprus parent company. The TPO, okay, so this was not regarding the characterization. It was more of the, I think both the things, the characterization, whether this is a equity or debt, and also how the arm's length price should be determined. The TPO determined the arm's length interest based on LIBOR plus 200 basis points. The assessee contended that FCCDs were issued in INR, that's in Indian rupee, and the nature was of equity instruments. They say this was not a loan, it was an equity instrument, and the interest was payable in INR, and interest must be benchmarked based on the State Bank of India PLR rate. So that is what the assessee wanted. The tribunal held that unsecured FCCDs are debt, and therefore benchmarking done by applying LIBOR plus 200 basis points was correct. So I'll just discuss the next case and say that have my view on this one. Then again, Hyderabad Infratech Private Limited, that is again the Hyderabad tribunal decision. Here the tribunal gave a different decision. It says that compulsorily convertible debentures, CCDs, are a hybrid instrument in the nature of equity, and there they say this is debt, and they can't be considered loans. But in that case, it was considered as a loan. Therefore, TPO was not justified in treating the issuance of CCDs as loans and making TP adjustments on account of interest by adopting the LIBOR rate. Okay. In that case, it was said the LIBOR plus 200 basis points is okay. But in this case, it says no, you can't make adjustment because they can't be considered loan and this is equity. Okay, so I'll just make my observation on whenever a instrument is issued, okay, then the benchmarking need to be based on that currency. Okay, if the instrument is issued in Indian rupee, then it is to be it cannot be so far applied, or earlier LIBOR could have been applied. This is the interest rate particular to the correct currency, whatever is the benchmark rate available in the market or in the public domain, that needs to be used. So here there's a confusion that in case of if the Indian loan is issued, still the tribunal said that it is possible that LIBOR plus 200 basis point is possible. I think this situation is very clear now. This is regarding the entity of the partnership. So those were regarding the financial instruments, and this is for the entity. So a Linklaters case is very famous case. The assessee, a UK-based LLP, is entitled to the benefits of India-UK DTA. The tribunal held that the income of the partnership firm taxed in the UK in the hands of its partners qualifies for treaty benefits, and the assessee is eligible for the same. So what had happened, the Indian Tax Administration, whatever payments were made to that partnership there, that they did not allow the treaty benefit because the partnership was fiscally transparent in that country. And based on that, it was considered, because it is not liable to tax. Therefore, it is not an entity which is entitled to the treaty benefit. Amendment to the treaty came much later on, that if it is received by the partners or beneficiary, then also the benefit can be given. But this case is prior to that, or but the tribunal held, because that the income is taxed in the hands of partners, may not be in the hands of the partnership firm. In that case, also benefits will be given. And Herbert-Smith case is also same. So I'm not saying that's a similar decision. They say that yes, if it is taxed in the hands of the partners, qualifies for the treaty benefit. This is also UK tax treaty, so this is the same thing. This is a decision of the Mumbai Tribunal where the treaty was India-Netherlands. Okay, I am unsure whether the decision was really correct, because here the assessee, a trustee of ING emerging equity-based funds, is entitled to treaty protection under the India-Netherlands DTA. The income from sale of shares is taxable only in the state of which the alienator is resident, that is in Netherlands, and the assessee is eligible for treaty benefits as the income is taxed in the hands of the beneficiaries in the Netherlands. So what happened, that this fund, which had made investments in India, and this fund was denied the benefit of the tax treaty because the fund itself was not taxable. It was not liable to tax. But the tribunal took a position, might be it was argued like UK tax treaty or Linklater case or whatever. Then the tribunal was persuaded that because the income is being taxed in the hands of beneficiaries, then the tax treaty benefit can be given. But if we look into Article 4.1 of the tax treaty between India and Netherlands, there is nothing like similar provisions what are in the US treaty or in the UK treaty. It simply reads that for the purpose of this convention, the term resident of one of the state means any person who under the laws of that state is liable to tax therein. So it is the entity which needs to be liable to tax. It is not that what happens to that income which is received by that and passed on to someone else. So looks like I'm not sure that what happened to this case, whether this is in High Court or what happened, but decision certainly cannot be accepted as final. Then the next case is General Motors Company USA. That is also the Lee Tribunal case. This is a very latest case in 2024. And here it says the assessee, a limited liability company incorporated in the USA, qualifies as a resident of the USA under Article 4 of India-US DTA and is eligible for treaty benefits. The assessee's income should be taxed at 15% as per India-US treaty, as the LLC is liable to tax in the resident state by virtue of US income tax law. I'm really unsure that what were really the facts which the assessing officer had looked into. But generally, the LLCs, those in US, my experience is that that those LLC might be tick the box and they are really not taxable. Okay, they are not liable to tax, and the LLCs are not covered by the tax treaty also, because tax treaty doesn't refers to LLC. And in that case, certainly I'm not sure that whether this tribunal was, yeah, I should not say anything, but certainly that it is not a case where the treaty benefits need to be given, because I can tell with my practical experience during my APA days, there were some companies, LLCs in USA, and those LLCs applied for the bilateral APA, and the process has moved very far, in the sense that even site visit had undertaken, and then later on I said, okay, what is the status of these entities? And we came to know this LLCs. Then when I asked a question whether those are the tick the box companies, they say yes. If those are tick the box companies, then certainly we are not giving the benefit of APA, because APA flows from the MAP, and MAP can be given only to the entities which are liable to tax in that country, the tax resident of the other country. And after much discussion, much negotiation, finally, the companies as well as the US tax authorities agreed that those entities are not eligible for the bilateral APA. So this is certainly a case. I'm not sure that how that decision came like this. Then now it comes to Article 11. And Article 11 allows the jurisdiction to preserve the rights of a jurisdiction to tax its own residents subject to defined limitations. Okay, so that is because you know that like US, it taxes its citizens wherever they are. Okay, wherever, whether India or Hong Kong, anywhere, they continue to tax. So to preserve that right, that it should not happen that because of the tax treaties, someone becomes resident of other country, and then comes the tiebreaker rule. Instead of US, that becomes resident of India or some other country, and they get the full taxation rights and not the US. So might be to preserve such type of taxing rights, this Article 11 has been introduced. But Article 11, it says that application of tax treatments to tax agreements to restrict a party's right to tax its own residents. Okay, so a covered tax agreement shall not affect the taxation by a contracting jurisdiction of its residents, except with respect to the benefits granted under provisions of the covered tax agreement. Okay, so that is means that covered, so that the sovereign right over the taxation of a resident of a country lies with that jurisdiction. But the tax treaty provides that a certain type of income would be taxed in the source state, and whatever is provided in the tax treaty, subject to that. Otherwise, there is no restriction on the rights of a jurisdiction to tax its own residents. And all these things later on, like which require the contracting jurisdiction to grant to an enterprise of that contracting state a correlative or corresponding adjustment. Okay, so this resident will be required to given Article 9 to deduct means benefit, like correlative or corresponding adjustment if the other country there has been a transfer pricing adjustment. So that right cannot be taken away by the jurisdiction. Second is that which may affect how the contracting jurisdiction taxes an individual who is a resident of that contracting jurisdiction if that individual derives income in respect of services rendered to the other contracting jurisdiction, like independent personal services and all. So independent personal services will be taxed in other jurisdiction, and that right cannot be, because that might be low rate of tax or no taxation, but that right cannot be taken by the country of which the person is resident. Third one is that which may affect how the contracting jurisdiction taxes an individual who is a resident of that jurisdiction if that individual is also a student, business apprentice, trainee, because there are benefits given to these type of persons or the professions or such type. Those benefits cannot be taken by the sovereign right of a jurisdiction. Then the next one is that which require the contracting jurisdiction to provide a tax credit or tax exemption to residents of that contracting jurisdiction with respect to the income that other contracting jurisdiction may tax in accordance with the covered tax agreement. So whatever is provided in Article 23, like the tax avoidance of double taxation by credit method or by the deduction method or exemption method, that cannot be taken away by these. So these are the restriction on the right of a jurisdiction to tax its own residents. Of course, they have all right to tax, but these are safeguarded, which protect residents of that contract jurisdiction against certain discriminatory taxation. So if we see Article 24, then that some means even the residents are protected from the discrimination provisions, and that those cannot be taken away. Then which allow residents of that contract jurisdiction to request that the competent authority of that or either contracting jurisdiction consider, so that the map rights cannot be taken away by that. This is what it says. The mutual agreement procedure right a taxpayer is having if the taxation is not in accordance with the provisions of the tax treaty. Next is which may affect how the contracting jurisdiction taxes an individual who is a resident of that contracting jurisdiction when that individual is having, like, he's a diplomatic mission, government mission, consular post, like somebody working for the United Nations, and that income is not taxable. Okay, then the jurisdiction cannot say no, because this is my resident of my country and I will tax all income. So there's a protection to that income is not taxable. Somebody working with the World Bank, working with the UN, IFC, IMF, that income is not taxable. Then which provides that pension. So this is regarding that also, if pensions, payments, annuities, alimony, if those are taxable in other jurisdiction, then those need to be taxed. If it is compulsorily taxed other jurisdiction, then those will continue to be taxed there. And the jurisdiction of which the person is resident cannot say, no, I will tax it. Okay, if you tax it, if it's provided in the tax treaty, then give the benefit of the tax of the credit for the taxes paid or etc. Then J, which otherwise expressly limit a contract jurisdiction right to tax its own residents or provide express. So if there is already a limit that contracting jurisdiction cannot tax its own residents for some type of income, then that is protected. Then paragraph 1 shall apply in place of or in absence of provision of a covered tax agreement stating that so if some country is agreeing to this article, then whatever is there, either this will substitute that article, or if there's a gap, it is not there, then this will be inserted or will be considered. A party may reserve the right to, for the entirety of this article not to apply, may say that, no, I don't want this article in my tax treaties. And second, for the entirety of this article not to apply to its covered tax agreement that already contain the provisions, which already contain this provision, then there's no need of inserting this one. Then each party, so this is what we said, the compatibility thing, that they need to say that what type of agreements are there, which it will be covered. But if no reservations have been made, then they need to describe everything to the OECD. Then India's position on Article 11. Article 11 of MLIs applies in place or in absence of, and it is not a minimum standard. So jurisdictions can opt out of this article entirely. The India has not made any reservation or notified any of its CTAs under Article 11. Thus, regarding the MLI, Article 11 will apply to all of India's CTAs unless the other contracting jurisdiction has made specific reservations or Indian tax treaty is not included as a covered tax agreement by other jurisdictions. Now we have 20 minutes. I will try whatever best is possible. Then Article 4, dual resident entities. Then competent authorities of both jurisdictions. Dual resident entities, we know that if by the tax laws of the domestic tax laws of the two jurisdictions which are party to the tax agreement or the tax treaty, if both consider that there's a tax resident of both the countries, then how that is dealt with in the tax treaty. So as I said earlier, because this was the other than individual, it was the effective place of effective management. That was the tiebreaker rule. But that really was very, very difficult to apply, because both the countries will say that place of effective management is in my country. So ultimately, most of the cases used to go to the mutual agreement procedure. So they say, instead of putting all these processes and the litigation and all that thing, why not to decide this case by the competent authorities themselves, and why the and provide the certainty either which country the entity is tax resident, and which country will give the benefits of the tax treaty. So Article 4 says the competent authorities of both jurisdiction to mutually agree on the manner to determine the residential status of dual resident of non-individuals regarding the place of effective management, place of incorporation or constitution, and any other relevant factor. So they will agree that based on what the tax residency will be determined by both the competent authorities. Apply in place of or in the absence of, and is not a minimum standard. Okay, so this is also that either it can substitute, because place of effective management is there, then that will be taken out, and these provisions will be put in the tax treaty. In the absence of such agreement, treaty benefits to be denied to such person unless otherwise agreed by the competent authority. So if the competent authority doesn't agree, doesn't come to a conclusion that which country the person is tax resident, then to that person the treaty benefits are to be denied. Then Article 4, dual resident entities tiebreaker rule optional provision. I'm just reading the provisions, what I discussed, what I stated in brief. Where by reason of provisions of covered tax agreement, a person other than an individual is a resident of more than one contracting state, means dual or triple resident, the competent authorities of the contracting jurisdiction shall endeavor, means they will just try it. Okay, it's not that compulsory that they will be deciding, but they will endeavor to determine by mutual agreement, by the mutual agreement procedure, the contracting jurisdiction of which such person shall be deemed to be a resident for the purpose of covered tax agreement. And the facts which will be considered are the place of effective management, place where it is incorporated or otherwise constituted, and any other relevant factors. In the absence of such an agreement, such persons shall not be entitled to any relief or exemption from tax provided by the covered tax agreement. So the treaty doesn't apply to this person if the map is means the competent authority do not agree, except to the extent and in such manner as may be agreed upon by the competent authority. So they may enter into means provide for some benefits to the taxpayer, but for that competent authorities need to agree. Paragraph 1 shall apply in place of or in the absence of provisions of a covered tax agreement. So this is what I already said. Then a party may reserve the right for the entirety of the article, or it will say that it will not apply. It means that they will continue with the provisions of the place of effective management. Okay, then okay. And for the entirety of this article not to apply to his covered tax agreement that already addresses the cases where a person other than an individual is a resident of more than one contracting jurisdiction. Suppose if the tax treaty between two jurisdictions already have that the competent authority will decide the issue, then they need not do anything. They will just, because that is already there. Then for the entirety of this article not to apply to its covered tax agreement that already addresses cases where a person other than individual is a resident of more than one contracting jurisdiction, by denying treaty benefits without requiring the competent authority of the contracting jurisdiction to endeavor. So they just deny the treaty benefit. If somebody is a dual resident, then they just don't even go to competent authority. They just deny the benefit. So if some countries are having such type of treaty, they can continue with that treaty, and they are not required to opt for the new MLI Article 4. And next is for the entirety of this article not to apply to covered tax agreement if already addresses cases where a person other than an individual is resident of this one. So this is also one of the options that they can do. These are also one of the options and nothing as such important. and dual resident entities, a similar type of competitive clause. And India's position, India accepted the article without any reservations. Okay, so notification of existing provision is listed agreement pursuant to Article 44 of the Convention. India considers that listed 93 agreement contain provision described in Article 42 that is not subject to reserve. So what they are saying that, okay, I will just do away with the place of effective management, and all treaties of India will come to that whenever there is a issue of dual resident entities, then the decision of the tax residency will be decided by the competent authority. What are the implications? India has not provided any reservation respect of the applicability. India chooses to apply this provision and has notified 91 cover tax agreement where the treaty residence of a dual resident entity will be determined based on map. This MLI provision will apply only if the other contracting jurisdiction agrees to apply this article. Okay, so India says that yes, I will apply this map, but other country, other jurisdiction, suppose they have put a reservation that they do not agree for Article 4. In that case, because there is no compatibility between two jurisdictions or two authorities, in that case, the old provision of effective place of effective management will continue, or the Indian treaty is not a covered tax agreement in case of other party. Presently, a majority of India's tax treaties use the place of effective management test as a tiebreaker rule to determine the treaty residence of a dual resident entity. Now comes the last one, that is Article 5, application of methods for elimination of double taxation. So I was not asked to do this, but I thought of that covering Article 3, 4, 5, which deals with the hybrid mismatch arrangements, and that is the thing I'm saying. So Article 5 includes 3 options for contracting jurisdictions regarding methods of eliminating double taxation. So we know that Article 23, or mostly Article 23 in all the treaties, there is a provision for the avoidance of double taxation. And that can be by exemption method, it can be by the credit of tax method, or it can be by giving a credit of the tax paid. That is the possibility. And if suppose there is no tax treaty, then Section 91 of the Income Tax Act is there to give the deduction for the taxes paid in other country. So this MLI has provided 3 options through the jurisdictions, and option A says that the provisions of CTA that would otherwise exempt income derived or capital owned by a resident of contracting jurisdiction would not apply. So suppose if they are providing the exemption based method, that exemption would not apply where the other contracting jurisdiction applies the provisions of CTA to exempt such income or capital from tax, or limit the rate at which such income or capital may be taxed. Instead, a deduction for, okay. So if a country's treaty provides for exemption of that income, but the other country also exempt that income, okay, so what will happen? It will be case of no taxation, non-taxation. So the non-taxation is avoided by saying that the other country will not apply the exemption method. It will just only give a deduction from taxes allowed subject to certain limitations. So exemption, no taxation, that will be avoided. Then option B, contracting jurisdiction would not apply the exemption method with respect to dividends if those dividends are deductible in the other contracting jurisdiction. This is what case we looked into, the example 1.1, that in dividends are deductible. Dividend means that is interest in that country which is payer, that is deductible. So this will not apply. Contracting jurisdiction would not apply the exemption method. So dividends will not be considered exempt if those dividends in the form of which are characterized as interest are tax deductible in other jurisdictions. So that is the option B. Option C includes that the credit method should be restricted to the next taxable income. So this credit for the taxes paid in other country, that should be given, that is option C. So contracting jurisdictions may choose different options, resulting in an asymmetrical application of this provision. Contracting jurisdictions may also opt not to apply Article 5 to one or more of its CTA. So this is also optional. One can go for Article 5 and one may not go for Article 5. And there are different options also, what option one can choose. Article 5 of MLI is not required to meet a minimum standard. Therefore, it is not compulsory for the inclusive framework members to apply this. India generally follows the credit method to eliminate double taxation, but has a few treaties that operate on exemption method also. India has now opted for option C. So we have agreed for Article 5 and we have opted for option C in the final list and will apply the credit method to provide relief to its resident in place of exemption method. India's tax treaties, which specifically include exemption method, as notified in the final list, are Bulgaria, Egypt, Greece, and Slovak Republic. And this exemption method will be replaced by the credit method if those Bulgaria, Egypt, Greece, and Slovak Republic consider India treaty as a CTA, and they have also opted for option C. And this is option C. I am not reading it. This is what particularly this talks of only, or let me just read it because I have to, yeah. So where a resident of contracting jurisdiction derives income or owns capital which may be taxed in other contracting jurisdiction, means source state, in accordance with the provisions of a covered tax agreement, except to the extent that these provisions allow taxation by that other contracting jurisdiction solely because the income is also income derived by a resident of other contracting jurisdiction. Okay, so if that is income is being taxed in the source state, then the resident state, the first mentioned contracting states shall allow, number one, a deduction from the tax on the income of that resident. Okay, so a deduction from the tax of what will be there? An amount equal to the income tax paid in that other contracting jurisdiction. So income from tax on the income. So is this deduction of the tax is to be allowed as a deduction from the tax on the capital of that residence, which is a wealth. Suppose that wealth is taxed in another country and wealth is taxed in this country, then also a deduction for the capital tax paid in other contracting jurisdiction must be allowed. Such deductions shall not, however, exceed that part of the income tax or capital tax as computed before the deduction is given. So this is the rule which has always been there, that the jurisdiction will not provide a subsidy for the tax which is paid more than for whatever is being paid in this country. So if in other country tax is paid 100 and in this case the income is taxable for only, let us say, 60 tax, then only 60 will be allowed as deduction, not the 100, because if it is paid more, this country is not going to bear that extra burden for the taxpayer. Where in accordance with any provisions of the covered tax agreement, income derived of capital owned by a resident of contracting jurisdiction is exempt from tax in that contracting jurisdiction, such contracting jurisdiction may nevertheless, in the calculating the amount of tax on the remaining income or capital of such a resident, take into account the exempted income. So this is a worldwide income taxation. That is what provided. Okay. So then after all this, what is way forward? Because certainly we have the tax treaties. Then we have the MLI. And MLI, the India has given its position. In some cases, it says that yes, it agrees to the article. Let us say in Article 5, it says it is applying, it will go for option C. In respect of the Article 4, it is saying that yes, it accepts the article and it has not given any reservations. So it will replace the place of effective management test with the decision of the competent authority. In respect of Article 3, nothing has been done for the fiscal resident, fiscal transparency entity. That is means for the firms, trusts, and CIBs and all. In that case, the status quo remains. And so all these things, whether as a taxpayer or as a tax administrator or as a means intermediary consultants, they are really required to keep all these things of keep in mind and to analyze all these things. Certainly, the legal documents are the tax treaties and the MLI and the positions of a country which are available on the OECD database, and that the matching tool also is there. One can really look into that. but the countries have really done a great job by coming out with the synthesized text of the tax treaty. That is tax treaty, and whatever has been superimposed, whatever has been changed, in that case, synthesized text has come out. And most of the time, the synthesized text which has come out, it is with the agreement of the other contracting jurisdiction also. So this synthesized text, to the extent it is a sacrosanct document, but it cannot be as such because might be suppose some interpretation, translation because of the different languages and all. Some issue has cropped up. That's a reason in the taxpayer or the intermediaries or the consultant, they really and when taking a decision, they can look into as a base document as a synthesized text. But while taking a decision, when applying a tax treaty or looking into that, they really need to look into the tax treaty and the MLI. So thank you very much. I'm stopping here and let me see that. Yeah, please.
Thank you. So there are no questions from the audience. I had one question, sir, to ask.
Please, yeah.
You mentioned about the LLC taxation in a US treaty context.
Yes.
So there, my question was that if the entity in the US has opted to be taxed as a corporation and not as a pass-through entity, in that occasion, how would the
Yes,
would it
yes.
still?
I think if it has opted for taxation as a corporation, it is filing tax return as such, it is paying taxes as such, then certainly that is a corporation is will be considered tax resident and benefit can be given.
And sir, in the reverse scenario, because in Indian LLP, say with having a US partner, the US doesn't treat partnerships as a separate taxable entity. So practically, you may have had experience with such scenarios. So what complications would come where such a scenario is there and the US treats the partnership differently and India treats it differently?
Yeah, so we need to just go by the tax treaty, because when there is a specific provisions are stated in the tax treaty, I think we need to just see that whatever is covered by that, it is there. So if the partners or beneficiary, either the partnership or partners or beneficiary, if those are taxed in that other country, so those will be considered a tax resident for the income which is taxed. Let us say that partners are taxed. Let us say that the partnership is in US, okay, and there are 5 partners, and only 2 partners are in US and 3 partners are in Cayman Island, Bermuda, or some other country, okay. To the extent, because income will not be taxed in US, so the benefit will be given to the extent that income is finally taxed in US in respect of the 2 partners.
So
I had one question.
Yeah, please.
Follow up to Kush's question. So basically, when we say that in US, let's say for example, if the LLC is treated as a corporation because it has elected for that. So let's say again in the next year, it does not elect to be treated as corporation. So do we see year by year wise, or because the entity classification then gets changed in every year?
Yeah, certainly, Prerna, because if we see the tax residency certificate, which is looked into by the tax administration or for giving a tax treaty benefit for a particular year, that the tax residency may change year to year. Okay, so if it is a tax resident in 1 year and next year it changes, it says that, let us say it chooses to be a tick the box, okay, choose to be non-taxable. In that case, certainly that will change.
So there is one general question on tax rate for LLPs, which I think is a more general question, nothing to do with MLI. That can be easily Googled, I guess. So, sir, thank you so much for taking us through this very important aspect of MLI and of the entire BEPS scenario, hybrid mismatches. I think your experience and the way which you took us through the various nuances was really helpful, at least to me, and I'm sure to the participants as well. So thank you so much for sharing your knowledge and being here with us today. On behalf of all the participants and IFA India WRC, really appreciate your time and efforts. Thank you so much.
Yeah, thank you, Kus. I always, whenever there is a knowledge sharing, okay, because everyone is learning. Even I am learning even now, because when you ask me to do this, then I really require to read all these things. Otherwise, not everyone is having time for everything. Okay, so it is a just 1+1 trying to make 3. So thank you very much for inviting me, and so that really made me to do it, and just sharing, and really that how committed you people are. I'm really that I don't know, because see, I was just last week I was okay, in a European country, and they have a concept of private time, and I really heard the name of. So it was, let us say that it was my sessions were till 3 only. It was becoming 3:05. Some of them says, so now it's a private time. Okay, so in India, that's the reason we are growing. We are growing strength by strength, because we really devote time, and all of you who really, this already 8 p.m. and giving this time, and we really wish all success to IFA, WRC, or to as such. Thank you very much. Thank you for all this, whatever efforts you do. Yeah.
Thank you so much, sir. Yes. We'll see all the participants tomorrow at 9:30 a.m. for our next session. So you are most welcome to join in.
Yeah, thank
if
you.
you have.
Yeah, being Saturday, yeah, I'll try. Thank you, bye.
Yes. Okay. Thank you, everyone. Good night.
Bye.